If you're somebody that gets stressed because stock prices go up or down, you got to do some soul searching. You might not be right for this game. I love that company for the long term. That's an anti-stress stock. If your portfolio stagnates for a while, don't freak out, buy the dip, and don't trip. The stock market can be a very easy game unless you have no patience. The ones that win in this game over time have incredible patience. The stock market is like a roller coaster. Now, like a roller coaster, some people go on it and they say, that was fun. The stock market is a huge moneymaker long term. So just understand short-term drama, long-term success. If you're an American Express shareholder or RH shareholder, be sure to give me a thank you for that. You know what I do during time periods like this, when the market's not moving up and you get 5% down in the Qs? You know what I do? You gotta be flipping my flapjacks. Look at these moves out here, ladies and gentlemen. Crude oil is up 10% today. The VIX is up about 10% today. GSG, the commodity index, is exploding higher, almost a 5% move. We got to talk about what's going on in the market, a bunch of stocks here at the top of the video. Once we get done going through that, I made some big moves out here today. I'll tell you what those moves are, why I went ahead and did those. And then after we get done going through that, the third thing we're going to get into today is I want to react to this video to buy the dip or to not buy the dip. Okay, we got a lot to go through. All I need from you guys, if you could just quickly smash that little like button, hit that little thumbs up icon, that would mean the world to me. Make sure you subscribe to here to the channel additionally, okay? Alrighty guys, so let's get rolling here right off the bat. Crude oil, guys, look at this 5-day. Look at this 5-day. You never see this. Never. Like this is like, woo. I highly doubt anybody's watching us right now that has been through a market where crude oil went up 23% in 5 days. I'm sure it's probably happened at some point in time, but this is not something that regularly happens. This almost never happens. And I mean, the Middle East always has drama, but when the drama gets stepped up, oil price goes crazy. And that's still like this to this day. I mean, unbelievable move, 23% in 5 days. But I want to show you the scariest chart of all charts in the stock market. This one is downright frightening. Look at this. And a lot of you guys might not know this unless you've been watching my channel religiously for a long time, then you do know what this is, but this is going to be scary. GSG. Look at a year to date for GSG. This is a commodity basket, the commodity index. It's up 28.5%. That's devastating. That means basically what's coming down the pipe here is a lot of inflation. Prices are just going to go up because, I mean, you know, it's as simple as that, right? And crude oil is a huge component of that. Gas prices are already exploding all over the United States of America right now. Whew. I mean, it's going to get a lot worse too over the next few weeks. So we're going to be basically in a situation where people are going to be paying, my guess is somewhere between 50 cents and 70 cents per gallon more next week than they paid last week. Yeah, yes. Like just in a 2-week gap, what they're going to be paying next week versus what they paid last week. We're talking 50 to 70 cents per gallon additional. That's not a small amount. That's a huge number there, right? You don't usually see, and as somebody that used to work in that industry, like, you know, when it came to like gas stations and management and all that, right? Like you don't really see a 50 to 70 cent jump in a 2-week span almost ever. Even 15, 20 cents is pretty big. But 50, 70 cent jump, oh my gosh, that's insane. So basically gas stations are just going to be raising their price like insane right now, right? So that's going on out there. Put to call ratio, I was talking to my private stock group about this here today. By the way, if you ever want to apply to join my private stock group, get all those exclusive videos, course curriculums, Discord chat access, 1000X access, I'll have that as a pinned comment down there today. You can apply to join us in there. But I was talking with my private group about a few things. One is I was talking to them about put to call ratio. There's something you guys might want to track, and it just kind of lets you know, are people freaking out? Are they buying a lot of put options or not, right? Now, usually people are late to the game when it comes to put to call ratio, and they start buying put options when it's already too late. I'll give you a really good example of this, right? Look at put to call ratio and how crazy it went here back in April. Right? Put to call ratio goes insane. Insane, by the way, for put to call ratio goes over 1. High is anything above 0.8. Very high is anything above 0.9, and then like insane as anything above 1, essentially. Okay, because like usually people should be buying more call options. The market goes up usually, so people should be always buying more call options, put options. So when it goes over 1, you're just like everybody's loading up on puts. But look at this, everybody's loading up on puts in April, right? This is late to the game, bunch of late to the game people. The market was already was already bottoming sometime around April 10th, April 12th, somewhere around there, right? Let's pull up a 1 year here of the NASDAQ. So NASDAQ bottoms right here, April 8th. Meanwhile, people are still loading up on puts. They just started really loading up on puts like the previous week and then kept loading up on puts. Meanwhile, the market's already bottoming and moving up. Late to the game. So keep that in mind. Usually people are late when it comes to buying put options. You know, they don't really see it in the future. So if you ever see that put to call ratio go really high, just know you're probably at the bottom rather than a top situation. IGV is actually moving up here today. That's extraordinary because, you know, IGV has been so weak, like incredibly weak, but it has clearly bottomed and it's moving up. And this is despite the market just being so weak, right? We're looking at a NASDAQ that I believe is now down over 6% from all-time highs. No, not quite. Close. It's close to down 6% from all-time highs, but it looks like it's not quite there in regards to that. TLT also down, which is interesting here today. S&P 500 is down about 1%. Dow Jones Industrial Average down. 520 points. Oh my gosh. Wow. Russell down about 2%. Bitcoin down. Ethereum down. And those have actually held decent. Look at what in the world's going on here. The planet's up a bunch today. Oh, you know what it is? Gas prices are up. And they think that gas is that gas, but this is a different type of gas, okay? But planet's up. TSLZ obviously appreciating here today. That hedge has done pretty well. ServiceNow, look at ServiceNow. Man, is that stock strong. Oh my gosh, like that stock was so weak. On a 5-day, it's up 14%. This one bottomed recently here, kind of around when the IGV bottomed. And from that bottom, it's already up 18%. Yeah, nice 3% move there for now. Palantir's holding strong, and that really is on the back of one, IGV doing better, right? Palantir can kind of get grouped into a lot of those SaaS-ish type companies. But additionally, they're obviously a defense play, right? And so people are buying Palantir for both of those reasons right now. And that's why that stock's actually seeing decent momentum right now. AMD is actually a surprising one. That one's green here today because you would just assume, given the move down for the NASDAQ down about 1%, you would assume AMD would be down, right? But that one's holding up well. Elf on a Shelf's a great buy right now. Anything under 100 on Elf's a great buy. Revolve's also a great buy, 25 on that one. Such a great income statement, balance sheet. No one talks about that stock really other than me, but it is a tremendous stock. Adobe is a great buy here today. Amazon's always a buy if you're a long-term investor. Keep in mind, short-term's volatile in regards to that. Celsius Holdings. Listen, I like this stock a lot. It's a big position for me in the public account. And this is a position that I added to literally today in one of my portfolios. So, if not two of my portfolios, actually. I listened to a conference call. I never got to listen to a conference call when it first came out. So I listened to it last night on 1000xstocks.com. And great conference call in regards to the integration of the Pepsi distribution network with Alani, with Rockstar. So, and also talking about margin profile going up from kind of 47%-ish range to they're talking about in very short term, like as in the next few quarters, they should be able to get it to low 50s. In longer term, they're aiming for mid 50s in regards to gross margins on this company. So Celsius, I really like what's going on there. Really like it. And that's one of those stocks. Listen, man, sometimes you need a stock that you just don't have to stress over. Right? Now, if you're somebody that gets stressed because stock prices go up or down, you got to do some soul searching. You might not be right for this game, okay, if that stresses you out. A stock like Celsius, think about the business model. They sell energy drinks. They're not going to magically be disrupted by AI, right? Okay, stuff's going on in the Middle East, oil prices are going up. Okay, so that could cause, short-term gas prices go up, which causes short-term, potentially more money to transport your stuff around the United States, right? Or whatever. It's all short-term stuff. The bottom line is you're building a brand that hopefully is around 10, 20, 30, 40, 50 years from now, right? And that's what you're trying to do when you're a drink company. You think about Monster, you think about Red Bull. I mean, those companies have been around since, Red Bull really the 90s, and then Monster since about 2002. And those brands are as prevalent as you've ever seen. And so Celsius is obviously trying to do that with Celsius, Alani. Now they also have the Rockstar brand as well. And it's just an easy hold for the long term. Sometimes you just need some anti-stress stocks, and Celsius is that. In terms of stock price, Celsius is crazy. That's a crazy stock. Let me pull up a 1 year of Celsius stock. Look at this. This stock was all the way down to $25. This is just in the past year, right? $25. It has been as high as $64. Today it's $43. So it's a drama show in terms of stock price, but the business model is actually not a drama show. They just execute. Nike is a great buy right now, 57. PayPal, we talked about that one a lot recently. Meta's just floundering. Everybody wants to see the depreciation numbers. We'll see those over the next few quarters. American Express, a great buy right now. Amex around 300, or especially if you can get it below 300, steal deal. Wynn Resort's a good buy, but if it goes under 100, that's a great buy. Estee Lauder, anything under 100 for Estee Lauder. EL's a great buy as well. Cheesecake, $60. That's always a great buy as well. I like Honest as well, $2.82 here today. Honest still is a $2 chuck. Anything you can get in the $2 chuck range is a deal for that one. As far as retail trader investor type stocks, a little red, but they're not actually holding up decent. I mean, those stocks have already been devastated. That's the thing. They've already been devastated. Looking at the big tech watch list here today, MU is getting hit the worst of everybody, and ServiceNow is the best. ServiceNow, SaaS related stocks. My possible buys watch list, looking at this one. Bath and Body Works. This is one, obviously they got to transport a lot of soaps, lotions, and candles all over the place. And that one is getting hit hard because it's worries about that could affect your margins negative in the short term. But all that stuff is here today, gone tomorrow. Gas price went up a lot. 6 months from now, gas price could be down big, or 12 months from now, or 2 years from now. This here today, gone tomorrow, right? Companies stay, they last. But look at Bath and Body Works. Forward P on the stock in the 7 range. Geez, it's pretty darn cheap, right? It's hard to get that. If you buy Bath and Body Works today at 20, it's hard to get hurt on the stock over the next 2-3 years. All things are possible, right? But I think that's a hard stock to get hurt in over the next 2 or 3 years. Now, we could debate on how much upside is it. Is it go to 25? Is it go to 30? Is it go to 40 over the next, 2-3 years? That's debatable. But in terms of getting hurt for the next 2 or 3 years, yeah. Fubo, that one just continues to flounder. Everybody's just waiting on, numbers in, more data in relation to the company and where they're headed. RH down to 145. I'm very intrigued. RH. Keep going down all the way to Chinatown. That's one that, gas prices going up this much definitely very negatively affects RH. There's no debating that, right? I mean, this is a company that has to transport massive things all across the world. No bueno. No bueno. Yeah, their furniture is big and heavy. Sheesh. So yeah. Whirlpool's under 60. This is another company that has to transport very large things all over the world, right? Washers and dryers and refrigerators and ovens and all that stuff. So that one's under 60. Definitely has me very intrigued. I don't know, man. I might come in and start a position in these stocks next month. I might. I'm seriously considering it. They are beaten down to a pulp. So I might come in and start a position in those 2 stocks. I hope you guys enjoy all this stock talk, by the way. Robinhood, 78. Intriguing. I mean, not really a stock I want to buy, but I got to say, it's not bad. Priced under 80. Hims is 15. That one's kind of interesting to me. Oh, I like Celsius at 42. Oh, yeah. And then a lot of these are kind of the normal suspects there. Housing stocks here today. Ooh, a lot of these stocks are getting hit big. Commodities going up the way they are. It's just not an ideal situation for housing related, right? Okay, so that wraps up that there. Okay, so now let's talk about stock I sold today, or a position I sold today. Let's talk about the big buys I went ahead and did. Okay, so let me show you a little something here. Okay, so this is one of my TSLZ positions, a batch of shares I have in the public account. I have 2 batches in there, and this is one of those batches. This one I bought February 11th, so less than a month ago, made 12% on it, and I said, I'm out of this one here today. Now, the rest of my TSLZ, which is about probably a little less than a $50,000 position, I'm going to hold those for now. That batch, I'm kind of looking at if the Qs go down 10% or more from all-time highs, and right now we're around 6%, keep that in mind, I'll likely get out of the rest of that TSLZ. I'm not holding that for like a 20% downside in the market or 30%, although those things are possible. I'm just not holding it for that. If I can get 10% there, I'm good. I'm good in regards to that. So I sold this entire batch here today, which gave me proceeds of about $38,000 roughly. And so what I ended up doing here today, here's a whole public account, by the way. And I posted this inside my private stock group. Once again, if you want to track my moves each week as well, you get access to that inside my private stock group. That will be pinned comment down there to apply to join us in there. But take a peek. I bought a big batch of American Express here today. Big batch. Yeah, I like Amex. I could add Amex this whole year. No joke. I could build Amex into a multi-$100,000 position. I love that company for the long term. That's an anti-stress stock. As far as the stock price goes in the short term, who knows? Like, it's going to be what it's going to be. But as far as the company, it's so anti-stress. Amex, are you kidding me? Are you kidding me? Such an anti-stress stock. I mean, just a great business model. Just such a strong moat around the company. Like, I love this company. I really do. I want to build this into a big position. There's certain companies you can just build into a big position, just hold it for the next 5, 10, 15 years. Nike's another one of those, right? Which brings me to Nike. Nike is another one I bought heavy here today. I know this one's so out of favor. No one wants to own Nike stock right now, but I think they're going to be just fine over the next 5, 10, 15 years. And that's another one of those stocks that I can just hold for the long term. I think it's going to be a great money maker for me. I think it will pay me out tons of dividends. I think the stock price will appreciate greatly over the next 5, 10 years. And it's going to be a good story. So that's bottom line in regards to that. I also bought some Honest here today. So increased my Honest position overall. So yeah, I mean, we got a lot of bangers in this portfolio. Meta up 558%. AMD up 77%. Amazon up 52%. That's nothing too crazy. Salesforce is now green for us. Cheesecake Factory, remember, this doesn't even include dividends received for these stocks. That stock's up almost 50%. Celsius up 74%. Estee Lauder's decent, 34%. Palantir's up 2,000%. ServiceNow is already up 21% for us in here. 21%. That one's flying. SoFi's up 124%. Elf's up 1,000%. Google McDougal's up 90%. Revolve's up 130%. Yeah, I think we'll be just fine. I think we will be just fine in the end, right? Like, the short term on the stock market is what the short term is. It's drama show, but you got to stay focused on great companies. These sorts of stocks, I think, are going to be great money makers for me over the coming years. They're so out of favor right now. Stocks like Nike, stocks like American Express, even a stock like Honest, I think they're going to make me huge money over the next few years. I could be wrong. That's fine. That's the cost of doing business. I think I'll end up being right, just like I am much of the time. And that'll be that. As far as the tax man loves me. Look at this. Look at this. We're in early March. I've already taken $355,000 of gains in the public account in 2026. Oh my gosh. And this is coming off of last year was $500,000, $600,000 in profits taken in the public account. Oh man. Oh, does a tax man love me? Oh yeah, they make some money. Okay, let's go ahead and react to this video on to buy the dip or not buy the dip.
I think the central question remains whether to buy the dip or not, because these moments, as we know, they cause volatility.
It's funny, this is from yesterday. The crude was at 79, now it's at 89, just like that. One day later, oh my gosh, not even 24 hours later.
We know that. They often don't cause worse, okay? So I would suggest that these moments can be, for many, paralyzing. They can also be opportunistic. What do you think?
I think, what's your time horizon, right? I think that's what investors need to ask, what your time horizon. And buy the dip, it's like we have so many sectors to buy the dip. Do you want to buy software dip? Do you want to buy financial dip? Do you want to buy the Korean dip, private credit dip? And so there's a lot of opportunity.
Korean dip, no. Private credit dip, no. Financials dip, no. SaaS dip, oh yeah.
Whereas the S&P is still flat for the year. I think the equal weight's up about 5. And so I do think that, especially within software, the software ETF, all those stocks look identical from a chart, which tells me that there's a lot of opportunity there. I think also financials are another opportunity there. So I think there's lots of spots that people can go in, do their own work, and buy some individual names that have been unjustly, let's say, sold off and where fundamentals aren't meeting the actual reality that the stock is trading today.
We'll get through a bunch of the different sector moves because they are interesting today. I love the context that you put, and at times like this, context is more important than anything. The S&P's down 0.2% on the year. So we've run a lot and we've gone nowhere. What do we do as we look at the backdrop, what's happening geopolitically, and we realize that the story at home is still good? And until that changes, why would you react to something so far away, even as serious as it is?
So she brought up a phenomenal point there that I have to point out to everybody watching this right now. And I think it's a big thing if you want to make money over the coming years or not. Okay. You know what it was? She said, what's your time horizon, right? What's your time horizon? If you think you're getting the best deal on stocks over the next month, the next 3 months, 6 months, complete gamble. Who knows? Who knows? Like, there's a million things that could happen. Maybe crude goes to 100. Maybe crude goes to 120. Sends a market down crash in the short term, right? Who knows? But if you have a longer term horizon, it's a great buying opportunity today. It's going to be a great one tomorrow. It was a great one yesterday, right? And it's phenomenal deals you're getting out there in the market. So what's your time horizon? My thing is, I see a lot of opportunities out there in the market right now. It doesn't mean every stock's at a bottom right now. Although software stocks look like they've already bottomed unless the NASDAQ was to hit significantly more than what it's already been hit. But I see a lot of opportunities out there. And I have a long time horizon. I'm looking out years, right? And that's the way you got to look. It always bugs me when new investors to the market, especially young folks, get so impatient with these stocks and they're freaking out and they're panicking. And they're so like, brain frazzled. I'm like, dude, you have so much time on your side. Like, you're worried about, because you bought a stock and it's down, 7% since you bought it last month. And I'm like, you need to be focused on the next, double up of that stock over the coming years. Like, what are you focused on here? You're just focused on the wrong things, right? So anyways, yeah, your time horizon matters significantly.
So if you're asking me, should you panic and go jump headfirst into it?
No, I'm not asking you if you should panic.
No, of course not. Of course
that
not.
wasn't
Okay.
the question.
So,
whether you should panic.
Okay, I misinterpreted. Of course, the market looks forward. The market has been through its share of wars and skirmishes and geopolitical events. And generally, if you look a few months later, generally, it's calmed down and something has reverted back to at whatever level we were previously. So this is another example where we have sort of an explosion, literally and figuratively, that the market goes into some sort of oh my God phase. But here we are, and it's a few days later, and companies are reporting, and Broadcom had good numbers, and Nvidia and Jensen Huang talked about where they're selling their chips and what those chips will be doing, and the software stocks were oversold, and people are buying them, and the non-software or heavy-duty industrials, et cetera, were a bit overbought, and so people are selling them, and that's the way I would interpret it.
You kind of answered my question in a sense when you talked about unless there's some kind of oh my God moment. When you think about what are those moments at times like this, right? Is it oil to 100? Is that okay, now you got to start thinking about the inflation picture, the ripple effects into the economy picture, and all of the ancillary things that would obviously be impacted by a spike in oil to that magnitude, the Strait of Hormuz being closed or ships actually being attacked or things that would change the calculus. My point and my question at the top is X that. X that. Do you sit back and you say, these are moments that have great opportunity along with them for long-term investors? Like, ostensibly, most of the ones who watch our program, despite the tactical nature of some and the various things that people do differently than some others.
For sure. And this is why I love being an active portfolio manager, because I can get super granular right now. So I'll give you a great example. A couple days ago, we added 5 positions to our international, not 5 new positions. We added 5 positions from our international portfolio to accounts that don't own them yet. Because with international stocks collectively being up 40% over the last year and 3 months, we've been really hesitant to broadly just buy the whole portfolio. But you wake up one day and you've got stocks in your portfolio down 7%, and they're totally unrelated, and there's no real consequence from whatever does go on in the Strait of Hormuz. So we added Veolia, Honda Motor, Nordea Bank, Seki Sui House. And those are some great things to add when they're down 7%.
Did you tell our producers about all those so they can throw them
No, sorry.
up?
It was a couple days ago. I didn't think we were going here with international. So sorry. I didn't, and it was adding existing positions in the portfolio.
Well, I just want them to be able to put something on the screen that shows our viewers, because you ran through those so quickly.
You want me to say, I'll say them again.
Yeah, do it again,
Veolia, Honda Motor, Seki Sui House, Nordea Bank, and DHL was the other one. So it's nice to be able to take advantage. And then in the equity income strategy, I said, okay, who doesn't own Columbia Bank shares? Because that company's fine. So you can pick off and see where there's opportunity. But I like it too, in that you do have opportunities where, last year, if you look sector by sector, it's pretty bifurcated. This year, I feel like it's even more severe. So you've got consumer staples up 13%. You've got consumer discretionary down 4% on the year. Within all these sectors, there's enormous rotation and movement. Now, I'm not super heavy on the software side, but within the software space, if you know that space really well, opportunities being created there. I can't tell you which ones are new and exciting today, but if you know that the way we know international, you can buy them.
I think some things are unanswered.
Okay, what do I think about international stocks, and then what are my favorite stocks in software? International, not a big fan. There's just so many opportunities in U.S. companies. So many opportunities in U.S. companies, it's ridiculous. And so, and if I want to play from an international perspective, I'll play a U.S. company. For instance, Wynn Resorts. Wynn Resorts, very international company, right? They have their properties here in Las Vegas, which attract a lot of international folks, right? But then they have 3 properties in Macau. They're building a property in the Middle East right now, and I know no one wants a piece of the Middle East right now with everything going on over there, but they're building that property as well. So if I want international exposure to wealthy clients, right, that live abroad, I think I like a stock like Wynn Resorts, right? And obviously a lot of the big tech companies make a lot of money from Europe or even from Asia in general, right? So that's my perspective on that. Usually it's not worth it. I think the only straight international stock I own, I believe, is Shopify. Aside of that, it's just, no. There's usually, the companies just aren't good enough, to just put it quite frankly. Now, in terms of my favorite SaaS stocks, listen. Salesforce, ServiceNow, Adobe, the same ones as it's been. Those are where I see the best risk-reward profiles out of that whole space. That's just my personal opinion, okay? I have been looking at a few of the cybersecurity plays as well. We'll see what happens.
At this moment, I think people can think that they know about software, but I would suggest to anybody who says that they know doesn't know. Because it's almost impossible to know what the disruptive force of all this AI is going to be on software companies. Some are going to have a severe problem, and they're going to be severely impaired. Others may not. We're still trying to figure out who's who and which bucket each of these companies falls into.
I think within software, Robert Smith, who founded Vista, right? Yep. He's been there forever.
Yep.
He put out a video the other day. I thought it was very, very, very logical. And he made the point that, yes, is seat-based going to have to change, right? Because let's just take that as we're going to have less seats.
Yeah, less seats with more agents.
So then he would say, well, I think that because this does cost to do compute, we go then to a work-based, where you have now, instead of 10 people, you have 5. Those 5 people are doing more work. Guess what? That work costs money to do the compute. And then in addition, I think what's so fascinating is he said that less than 1% of enterprise data, like the data at my company or the data at Exxon or have you, is actually being trained inside of AI right now. It's really just the internet, and that's the opportunity. And I do think that, yes, maybe these software companies, the multiples going forward just need to be lower, right? They need to be lower.
Well, that's what's happening now, right? They're re-rating for a rethink on where the revenue growth of that industry is going to be 5 to 10 years from now. That's the whole point of the pullback.
Right. And so the point is that I think the narrative does get a little disconnected to potential future fundamentals, because when you listen to Salesforce earnings, which once again, I bought it, I sold it, because I just can't get my arms around like these questions we're asking. But I do think when you listen to these software companies' earnings, they are still doing very well. And so if you put a lower multiple on them, they're not going to zero. And so that's where, like, I own a Zoom. I can get my arm around Zoom all day long. I think there's not that much downside. I think there's good upside. But you have to do that individually, because I said at the front of the show, all of those stocks, the charts look identical, and they're totally different companies.
True. Let's take a peek at Zoom here and see what's going on with Zoom. Remember when this was a darling? I think Zoom was like $500 during Rona. Let's see. So Zoom, yeah, revenue looks good, slight growth there. Margins look good. Margins look really good overall. Net margins have peaked up a lot for the company. Earnings per share, I mean, it looks pretty solid. Free cash flow looks good. Free cash flow per share looks pretty good. Operating cash flow looks pretty good. Operating income looks pretty good for Zoom. Let's see on a valuation basis. So 11 forward P on the stock, not bad. You know, it's just not the most exciting one, right? Like this just, I don't know. I would just much rather prefer somebody like a Salesforce and a ServiceNow that's going to give you much better growth in future years than somebody like a Zoom. Do you have to pay a richer multiple? Yeah, you do, but you just get such a substantial growth rate higher than somebody like a Zoom with a lot more products to sell.
As Jonathan Krinsky,
which makes them more diversified as a business model than somebody like a Zoom.
Forth the other day is whether the software stocks that have been down a lot are washed out. And you've seen some stability in the space. As we know, the IGV's up 7.5% in a week. Cyber's having a great week. Palantir's up. Bryn was just talking about some SaaS names like Salesforce. Snowflake's up. We've watched ServiceNow. All these names that we have talked about on such a consistent basis, and frankly, most of it negative. Is it bottoming, do you think? Because Microsoft, if you want to throw that in there too,
sure.
Look at the chart. We show it every day, pull a year.
So this is exactly the question that we felt would be important to answer. Let's compare the old economy stocks that have been surging with the new, I'll call it the new economy stocks, even though Microsoft isn't new, but including some of the others. And we have a chart here that shows that the current, this is old economy stocks, and I had a bunch of them in there, names like Caterpillar, Deere, Emerson Electric, Flowserve. This is where the forward PE of these stocks were the group. The average was 30 times, and and giving them the benefit of good earnings growth, we look at 11+% this year and 17+% next year. Then we looked at how are the new economy, the software stocks, such as where are they trading? 21 is the PE. So these stocks have come way down in PE and their growth rate. And these are numbers that I reduced from estimates that we had been using, and they're still growing faster than the old economy stocks. So I don't know whether the run-up was too much, it certainly was fast, or the run down too much. We know it was fast, but it appears to us that there is now this sort of disequilibrium where there's too much buying in these stocks that are cyclical, really.
Yeah, so, just to be quite frank, that, those stocks, those old economy stocks should not be trading like that, right? Now, another factor here is, looking at somebody like Microsoft, right? You're getting the stock for very cheap compared to what you have had to pay. I mean, it's become everybody got very accustomed to paying a 30 plus P ratio for Microsoft, and now you're getting the stock in the low to mid 20s. So that's very intriguing on Microsoft. And they still have great growth at that company, like great growth. So, forward P23, that's very fair for Mr. Softy. Very fair. Now, where you get into trouble here with a stock like Microsoft is you have to say, is that your best opportunity? And this is where the compare feature on 1000xstocks.com comes in. So we're going to compare Microsoft to Meta and let's compare it to somebody like an Amazon, right? And this is where you start having like, is it this stock or this stock? And that's why I love the compare feature here on 1000x. Once again, if you want access to this, that will be the pinned comment down there. Click on that and apply to join us in there. So forward P on Microsoft 23, but look at Meta 21. Meta, meanwhile, has very, very strong growth. Like look at current year expected revenue growth. Meta's in the, mid 20s, roughly, low to mid 20s, when Mr. Softy's at like a 16% number. So that's where you get into like, would you rather really have Microsoft or would you rather have somebody like a Meta, right? I would prefer Meta for sure. And then you look at somebody like an Amazon, that it's like, okay, higher forward P 27, but Amazon has a lot of room. I think they have the most room to raise earnings per share over the next, 5-10 years than even a company like Meta and a company like Microsoft. So that's just something to kind of keep in mind there, okay? Once again, if you want to apply, join a private stock group, private wealth group, get access to 1000xstocks.com, private Discord chat, exclusive weekly videos, all my course curriculums teaching you everything I got up here so you can take your game up to a much higher level. That will be the pinned comment down there. Some very interesting moves out there that kind of give you some tells on where this market's actually headed and where certain stocks are headed from here. So we're going to get into that at the top of this video. Then I want to react to this one, Tom Lee. This was actually from yesterday. He was talking about this is what the market looks like when it's bottoming. So I'll share some opinion perspectives on that. And then this just came out 11 minutes ago. Jensen talking about OpenClaw, the most important software release probably ever. So yeah, action-packed video here today, folks. I appreciate you joining me. If you don't mind, just smash that little like button, hit that little thumbs up icon. That's all I need from you guys. I appreciate you doing that. Make sure you subscribe to the channel. I'm trying to keep you guys up to date with everything going on out there and all the drama and everything. So yeah, make sure you're subscribed, have notifications on. Pinned comment down there today will be for a free little checklist. I'll tell you a little bit about that later in the video, okay? So right off the bat here, Dow down big. Now you got to ask yourself, okay, what is going on here? Why is a Dow down specifically so dramatically? The Nasdaq's not getting hit that bad today. Nasdaq, by the way, is down about 6% from all-time highs. So, a small correction in the Nasdaq as of right now, nothing too crazy. If we talk 10% plus, then we're talking about, a nice size correction here. But the Dow, 1,100 points down. What's going on? Well, let's go ahead and dive deeper. Okay, we see a problem. Do you see what I see? Look at Walmart stock. Walmart's a huge component of the Dow, and that baby's getting smacked today. That's an over 4% downward move. That's going to matter significantly to the Dow when you see Walmart stock down 4% plus, right? Also, you have some of these big healthcare related companies like Johnson & Johnson down 3.3% here today. Merck's down 3.6%. Amgen's down over 4%. Those matter. Caterpillar, that stock's been a beast, but not today. Down 4.5%. So that's become a very big weight in the portfolio overall. So ultimately, a lot of those sorts of stocks are what's pulling that whole index down in a significant way here today. Nvidia is not that bad. Apple, not that bad. But some of these stocks getting hit when you got 4 and 5% moves down. Yeah, it's going to be tough for the Dow to have a decent day, and that's why we see the Dow down 1,100 plus points here today. But what's fascinating is, do you also see what I see? Look at some of these stocks that we've been buying the last month or two. They're doing phenomenal today. Look at ServiceNow. You wouldn't if you would tell me ServiceNow stock's up 6%, Salesforce is up 5%. And the Dow's down 1,100 points? I'd be like, what? It doesn't even seem like that's possible. But that's what we have going on at this point in time. If you're in SaaS stocks and you've been buying these recently, you're like, this is an amazing stock market. This is the best stock market ever, right? Meanwhile, Dow's down 1,100 points. So really fascinating. But keep in mind, those stocks had just been wrecked. I don't know what else to say. Those stocks had been counted out. As of about a week or two ago, when that whole last kind of newsletter or Substack or whatever they call it, right? When that one came out about and it was, putting into this dark future about like everybody lose their jobs and no one needs software anymore, that seemed like the type of piece that comes out and bottoms stocks, because it's just like, gosh, you've gone that far, you can't go any further. When we've gone that dark, it's just no need for these companies anymore. There's no need for professional workers anymore, no need for anything. It's just like, how far from reality have we gone, right? And yet another day ticks on, and another day of what? Everybody still uses all these companies, just as they have the many years in the past, and they're still signing up for them and still spending more with them. That's what we see in all the numbers. Have you seen ServiceNow's numbers? Have you seen Salesforce numbers? I go through all a list of these companies. They're all doing better than ever. They all have amazing guidance, amazing numbers, amazing business models, and life goes on. But, things got very dark there for a moment, and people just threw out all these stocks, and for what reason, who knows, right? But they'll give you your reasons. Look at Adobe stock here today, up about 3.5%. That one's been on a nice move, past few trading days here. Stock like Adobe. I mean, let's pull up a 5-day here, up almost 11%. And let's pull up versus CRM, and then we'll pull up ServiceNow as well. Because these stocks, if you want to talk about showing a bottom, these stocks are definitely showing a bottom. Now, eventually, if the NASDAQ was to get hit enough, like these would probably get one last hurrah hit when it comes to these SaaS stocks. But assuming we don't get a 10% plus downward move for the NASDAQ, these stocks have already bottomed. But if all of a sudden you're going to send the NASDAQ down 10, 12, 15%, it's going to be hard to not get hit, right? But as of right now, as long as the market doesn't get hit significantly more than this, that means ServiceNow, Adobe, Salesforce, IGV in general, they've all bottomed, right? So just do keep that in mind. That's kind of what we're working with now at this point in time. TSLZ, this is my Tesla hedge that's doing pretty good today, but not like great. It's up 3%, a little over 3%, which is a good day. But given the Dow's down 1,100, I would have loved to see that one up a lot more than that. PayPal. Listen, ladies and gentlemen, something interesting's going on in PayPal. So you know what? Clear as day, in my opinion, people are buying up this stock recently, and it really has to come down to, I believe people are convinced that PayPal, because remember, this one bottomed at like $40 not that long ago, right? I believe that people are convinced PayPal's got to be bought out by somebody. And that's why we continue to see momentum in this stock. I mean, there's no way a stock like PayPal should be up today. The stock's up almost 2%. I mean, you could say with the SaaS stocks, okay, like those stocks has been dead and forgotten, and finally value investors are stepping in to buy them, right? But somebody like a PayPal, there's no way you could say, well, Dow down 1,100 points and PayPal's going to be up 2%. No way that makes sense unless people are convinced the buyout's coming, right? And so that's why I think that one continues to bid up. And it's up significantly from those lows it was at about a week or two ago, right? And so there's something likely credible going on behind the scenes. Now I understand, like, I believe it was Stripe denied the, I messed around here. I believe Stripe denied the potential buyout. But listen, that's what they're supposed to do. That's what they're supposed to do in this game, right? Like, you're supposed to deny that. But yeah, from those lows, it reached right around here. I got to take off the other PayPal here. It's up 23%. 23.23%. Michael Jordan. It's oh my gosh, PayPal, Michael Jordan stock. But it's fascinating, right? That's what I think's going on there. SoFi, actually, that's a surprising one. To see SoFi up on a day when the Dow's down 1,100 points, that's fascinating. ELF remains a deal. Amazon actually green today. That's a big win for Amazon. I'm surprised Win's not weaker given all the Middle East turmoil with the Middle East property. I thought Win might see 98 this week, 97, something like that, maybe even 95. That one's actually holding up a little better than I would have anticipated. Outside of that, not too much going on there. It's a lot of these stocks that had been the rotation plays, I feel like are really getting hit hard today. Let's go ahead and take a peek at housing stocks. So Rocket getting hit hard here today. Caterpillar getting hit hard, as we spoke about. John Deere getting hit hard as well. These stocks had been beasts, so let's be very clear about that. Pull up a 1 year cat. Are you flipping my flapjack? Stop it. Caterpillar's up 106% in the past year. What? No. Caterpillar? Come on, man. That's just silly. We're talking about cat here. 106% past year, flipping my flapjacks. John Deere's had a decent past year, up 25%. That's more normal at least. Caterpillar, a double up. What? That's just insane, right? That one's due for a big pullback. I mean, what's Cat's valuation at now on this baby? And I understand there's a lot of excitement about all the data center spend, and you're going to need a lot of machines to do all that, blah, 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 right? No. Cat's trading at a 31 forward P. No bueno. Cat's not the type of stock that should usually be trading at those sorts of forward Ps, ladies and gentlemen. Cat's the type of stock that should usually be trading between about a 10 and an 18 forward P. Okay? Between about a 10 and an 18. We're talking 30 plus forward P? No way that should be happening. No. This is bad. Oh, this is no bueno. Look at this. Oh, this is one of my favorite features on the charts feature for 1000xstocks.com, right? We show you historical PEs. And remember what I told you guys? What did I tell you? I said 10 to 17, 10 to 18. And look at where Cat usually trades, right? Look where Cat usually trades. And obviously now all of a sudden the PEs went insane. Look at this. Come on. Mid 30s, trailing 12 month P, that should, no. No bueno. So, Cat, that's a scary stock. And if that one comes crashing down, it's going to hurt the Dow significantly. I want to find RH 149. RH, oh man. RH is tempting me. It really is, ladies and gentlemen. RH Restoration Hardware. It is very, very, very tempting to me. So obviously numbers have been horrible out of them, but I expect a bottoming to happen and them to come back to life. It's just a question of, do I want to step in this stock? It's scary, but I mean, to be fair, a lot of times the most money's made when you buy a stock and it's scary. And that's the thing with RH. It's like, dang, the numbers are so bad. Balance sheet's trash at RH too. Look at what's happened to the shareholder equity. Great job, Gary Friedman. Great job, sir. Gary Friedman spending all that money on the buyback. I think the man's brilliant in terms of what he built with this company. The branding, I think is brilliant. But that buyback, I told you guys years ago, dumbest thing, man. He blew so much of the money's cash on this massive buyback at a bad price and put the company's balance sheet in a horrible position. Such a bad decision, man. Such a bad decision. But anyways, it is what it is. If it wasn't for that, I would be buying RH right now because the balance sheet would be a lot stronger. So I'd feel much more comfortable buying it. But gosh, man. Gary Friedman. And so he took a lot of shares off the market when he did that buyback. Great. Okay. Look at the drop off, boop. But, no bueno. Look at the current assets. Oh, it's plummeted for the company. Ooh, this might be the ugliest one yet. Look at this chart here on 1000xstocks.com for RH. Look at what happened to their cash. They used to be cash loaded. You used to be able to sleep well at night holding RH. Look at their cash level down. It's so small you can barely see it. And look at the debt load. I really want to buy it. I just don't know if I'm going to be able to. I really don't. Whirlpool's flirting at $60. That's one of those stocks that's like, is there anybody left to sell that stock? Like $60. When it comes to Whirlpool, there's another company that I expect to be bottoming here in the next, month or next few months in regards to their business model. And I expect it to get better from there. But this is another ugly situation, obviously, right? Look at the revenue, where that's trended for the company. Look at the margins. Ugly. Look at the earnings per share. It's all over the place and it's ugly. Free cash flow is ugly. Free cash flow per share is ugly. Operating cash flow is ugly. Operating income is getting a little better for the company. That's good. Shareholder equity, definitely in a much better position than RH, so I would feel more comfortable. The thing is, I feel like RH has a lot more, as long as it can make it through this storm, get out to the other side, I feel like RH has a lot more potential upside over the next 3-5 years. I feel like our Whirlpool has less risk over the next 3 years than RH, but I feel like the upside's not as extreme. So, I don't know. We'll see what happens. Also, not a great balance sheet of this company either, by the way. But it's much better position. You can sleep better at night than certainly RH there, okay? But that kind of covers housing stocks. Let's see retail trader investor type stocks here. So, MicroStrategy getting hit a bit. 5% is not bad. Bitcoin's holding decent today. Holding decent. HIMS continues to get hit. Oh, I wonder if that one's going to break 15. That one's just been, ooh, man, it's been an ugly stock. Ugly stock. We're Robinhood. I think I saw Kathy Wood just bought a lot of shares, which means it's going lower. Coinbase down over 3% here today. Palantir getting hit a bit. Little Dingo came with the turnaround there. 5.6% up today for the Dingo. Big Tech. Big Tech's getting hit a bit today, but it's not that bad. It's not that bad. By the way, anything under 200 for AMD is what? Is a buy. But yeah, Big Tech's not getting hit that bad today. A lot of the pain's just really in the Dow, right? And so a lot of these stocks are actually, you wouldn't think it's that bad of a day out there in the market, considering the Dow's down 1,100 points here today. That's a no bueno situation. And, the big issue we have going on here, if you're wondering, we have two big issues, okay? One, look at that 10-year yield. It's going higher. No bueno. You don't want to see that. That's bad. No. 10-year goes higher. Mortgage rates go higher. Keeps the housing market dead. That's not good, right? I'm so happy I locked in like 2 weeks ago at 5.75 for my next house, because if anything, I think it might go back over 6 in regards to mortgage rates here. So that's not good. Inflation expectations are starting to go higher, which then inflation expectations start to go higher. That means people are doubting the Fed lowering rates as much as they might have anticipated as of just a few months ago. Look at GSG. This is a commodity basket index. Oh no. Oh no. Oh no. Oh no. Oh no. Oh gosh, no. GSG is now up almost 24% for the year. Guys, when that goes higher, that means everybody's going to be paying higher prices for stuff. That could mean electricity. That could mean gas. That could mean just everything. And if inflation expectations go higher, that could mean people get worried about the Fed not even lowering rates this year. And then if it goes bad enough, you could start worrying about, you could start actually worrying about the Fed having to raise rates again. Oh, that'd be devastating in the stock market. Absolutely obliteration. So let's hope it doesn't get that extreme, but this is not good. Oil's up 8% plus today. Ooh, somebody got a 296 GTB. Not me. But somebody got one. That's good. Rich people still being rich. IGV, but crude oil up 8%. I mean, look at the VIX here today, up 21%. Oh my gosh. But crude's just moving. Crude's now up 40+% on the year. Oh boy. That can't mean good things for gasoline prices come this summer. Even the spring. But specifically, I'm always thinking, a little further out, so I'm already thinking of summer. But yeah, that's not good. None of this is good news. 10-year going higher, bad news. GSG exploding higher, 3% moves. Insane for a day for GSG. Horrible news. Crude oil going higher, horrible news. That's bad news on bad news on bad news. So I don't have any good news for you in regards to short-term price action. Only good news I have for you guys, you know what it is? It is, well, other than SaaS stocks, those are certainly good news, right? I'm kind of happy we've been buying those. But the other good news I have for you is you get great pricing. You get better pricing to buy stocks if you're a long-term investor. If you're worrying about retiring today or tomorrow, I don't know, man. Tough times. But if you're worried about retiring 5 years from now, 10 years from now, 20 years from now, 30 years from now, they'll take stocks as cheap as you can get them, right? And so do keep that in mind. Okay, so let's go ahead. Let's react to some videos up here. First one up, Tom Lee. I'm only going to react to the Tom Lee part specifically. That's some other parts in there, but I just really want to hear from Tom Lee.
At Post9, it's good to have you back.
Great.
Your thoughts as you look at these markets. Been real interesting price action over the last couple of days. Thought our reporters set the table very well on the issues at hand that investors need to keep their eyes on. What about yours?
Yeah, I think the headlines have been scary. No one wants to see the U.S. in a conflict. But I think it's been spot on to note that markets have been taking this much better than expected. I don't think anyone can say we're bottomed yet, but this is what looks like the makings of a bottom, right? That you get bad news and the markets are taking it in stride. And more importantly, I think we've had a position reset. And so...
Oh, hold on, Tom Lee. In all due respect, sir. Listen. The market's very good. Investors, the ones that control big money, are pretty good nowadays about being able to, if they're caught off guard by something, like not have the market freak out, that initial wave, position for downside, and then cause the volatility from there, right? And you can go all the way back to the housing crisis, and there being a lot of thoughts around this, about there was huge problems in housing way before the stock market started to go down, way before the swaps started to be revalued and things like that. And there was a belief that a lot of these Wall Street funds would not allow certain products to reprice until they had positioned for that downside so they can make money on the downside as well. And then they started to reprice these things. And so sometimes this happens in the stock market where, an initial thing will kind of shock, but it's almost like they try to hold the show together. Then they position for that downside. You also see a ton of puts being bought, shorts being made, and then magically all of a sudden the market starts going down with not much new information. It's the same information, but now all of a sudden the market cares about it. It's like, whoa, thought the market didn't care about this, and now all of a sudden it cares about this. It's like, wait. We'll allow it to go down when we're positioned for it to go down. That's when it can go down, right? And so, there's always going to be a level of manipulation that happens in the market, and you have to understand that. And that's another reason why don't even focus on trading. Own great companies for the long term. You can't control whether these companies go up or down in terms of their stock price in the short term, and that's going to be what it's going to be. But focus on the long term with these companies, because playing the short term games doesn't end well.
On the other side of this, I think is going to be a lot of opportunity.
What would give you the confidence to say, you know what, that's a sign of a bottom? What do you need to see?
Well, some things, like if we go back to April, a simple thing would be the VIX making a spike to over 40. Last year was 80, but we won't get to 80. And then, of course, retracing. That would be a clean sign because that's so much de-risking. Another sign would be we get another scary headline and gold continues to sell off, and then stocks actually turn green on the day, because that means we've washed things out. I think we're pretty close.
You're watching oil as closely as everybody else is. I thought it was interesting, some of the notes today. UBS.
I'll explain in just a moment what price the VIX usually means to buy heavy versus just buy versus, you need to load the boat type situation.
We expect only minimal or a brief disruption to global energy supplies. We therefore stick with our base case that U.S. equities, will produce good gains this year. Katie Huberty over at Morgan Stanley. Recent geopolitical events unlikely to change our bullish view on equities over the next 6 to 12 months.
I think oil, we saw things that kind of made sense to me. Oil spiking on closures or potential closures of the Strait of Hormuz, but the response from Washington. And I think that's maybe more important, that I don't think Washington wants high oil prices into the midterms. And of course, it's very unpopular with Americans. It's a big burden. So I'm going to be in the camp that I'm watching the price action. I think it's encouraging that oil's not surging into the close.
Hey, part of the Huberty note focuses on the AI trade, which has been really interesting, I thought, over the last couple of days. Back, some might say, to that safe haven type price action. Look at right now. Microsoft's up, Meta's up, Amazon's up, Nvidia's traded better over the last couple of days. What do you make of that?
Well, in our view, March was the makings of a bottom because the software, the Mag 7, and the cryptos we thought were like 90% through to their winters or declines. they are outperforming, and I think that's a sign of leadership. But fundamentally, you're absolutely right. If we get global trade disruption, you still need AI, and you still need a Mag 7. So I think they're actually good fundamental stories.
There's a technical side to this story, too. Stay with me just a second, because certainly one of the key questions.
Okay, so let me explain the VIX for a moment, and when you know pricing's really great to buy versus like okay to buy and those sorts of things, okay? So when it comes to the VIX, when you see the VIX go 25, like over 25, you're usually getting pretty good pricing on stocks, and you should be buying. You see it go over 30, you need to, let's just call it amp up the buys. You see it go over 35, you need to be buying heavy. You see it going over 40, you need to be loading the boat. You see it go over 50, you basically need to go all in the market, usually, in almost every situation. You could trace the VIX back and basically see every single time the VIX has ever gone over 50, and you should have basically been going all in. I can't think of any time period where it didn't make sense. Like literally, I could show you any time period where the VIX went 50 plus and you should have been going all in the market. Like it was, you got insane steal deals. And even 40 plus, you need to just be loading the boat type situation. So yeah, that's just always keep those numbers in mind in regards to the VIX. Maybe someday that will be broken for the first time ever, but just keep in mind that would be the first time ever. It always ends up working out in the end.
Want to opine on that?
Yeah, I agree with almost everything said by both Krinsky and...
Oh, hold on.
For the U.S. economy, so that when they reopened it, stocks were rising, and then they just absolutely soared up to new highs. So that sort of told people, you know what? Wartime is not always a bad time for the markets, and certainly we're not in a World War I, World War II. Certainly, let's hope it doesn't get that way. But it had those periods, when VIX is above 20, I know Tom wants it to go above 40. That would be the spike that would probably mark the bottom. But it means there's an awful lot of hedging that is going on, a lot of risk positioning. If we get through this war with some of our objectives through, I think we're ready for a big bull market in 2026.
Want to opine on that?
Yeah, I agree with almost everything said by both Krinsky and Jeremy Siegel, that this is all the hallmarks of creating...
How dare you call him Mr. Siegel? That is the professor, Jeremy Siegel. Put some respect on his name.
Good opportunities. So I think investors do need to look beyond the headlines, maybe think 3 months, maybe even a month forward, and we just have to kind of wash through this bottom. But we already know where the leadership could be coming from. It's the software, the Mag 7s, and even the cryptos.
Professor, does this...
with regard to what Tom Lee says there, listen, don't look 1 month or 3 months from now, because who knows what could happen. Market could be even messier a month from now, 3 months from now. Don't look at that. I would say focus on 3 years from now, where the market is, 5 years from now, 7 years from now, right? That we have a lot more certainty of. But what happens over the next 1 to 3 months? Dude, who knows? Like, what happens with this whole Middle East situation? Does it get way more out of hand? Does it get more controlled? Does oil go 100? Does oil go 120? Does GSG keep flying? Does that then put those Fed in a situation where they can't cut rates this year? What does that mean for the market? Does a 10-year keep going higher so that continues to have a dead real estate market? Oh my gosh. And then could there start being so many worries about the economy because of inflation, but inflation the Fed can't control, like oil price and things like that going high? Does that also mean the Fed actually would start to cut rates because they're more worried about the economy than at that point in time than something like oil price, which they can't control? The Fed could raise rates to 1,000,000%. It doesn't mean like magically oil price is going to come down. That's not the way it works. So one of the big factors on why GSG is going so high and why you might see a lot of inflation in the numbers has to do with gasoline price. They can't affect that. But if it affected the economy negative enough, then the Fed could maybe lower rates at a faster clip than people expect. Dude, the next 1 to 3 months, who knows? Don't focus on 1 month out. Don't focus on 3 months out, because that's a mess. But do focus on 3 years from now, okay? So that's what I'll say about that, and great companies.
Tom suggesting perhaps rekindle the mega cap trade in some respects for the idea that at times of turmoil within the markets, these have tended to be a bit defensive.
Yeah, well, I remember once we thought that Apple was the big defensive stocks. When there's times of potential recession or international disturbances, really no stock is totally immune. We really need to get through this, I think, for the bull market in both segments of both the value stocks and the rotational stocks as well as the Mag 7. But, let me tell you, when you take a look at some of those, the Mag 7 stock like Nvidia that selling in the low 20s, some even say lower in terms of price earnings ratio, that is an awful lot of discounting, let me tell you, for a company that has been growing 30-40% a year.
Yeah, you would agree though in the bigger picture as we wind our conversation down that energy, that complex, and oil prices are the most important thing to watch right now. Not only from a sentiment standpoint, obviously for the economic fallout perspective, and then how it relates to the Fed as well, and what its road politics ahead is going to be.
Yeah, and as Tom mentioned, I mean, we are coming to the midterms. And, we have had low oil and gas prices under Trump. Now, the wholesale price of gas, let me tell you, has gone up 50 cents over the last 3 days. Now, it takes about a week to work into the pump. I worked it out that if it does go up by, 50 cents, we will be in the middle of what gas was during the Biden administration, but no more Trump discount that he was counting on early on. So it's not only a question about the Fed does and the economy. It really is going to be important for the political outlook.
Tom, you get the last word.
Yeah, well, I'd say I think investors just need to be kind of patient, cautious, and wary, have a bit of firepower, but I think opportunities are emerging.
All right, gentlemen, I appreciate very much the conversation as always.
All right, let's run into this next one here.
Having a moment after Nvidia's CEO Jensen Huang called it the single most important release of software probably ever. Deirdre Bosa has more. And Deirdre,
that's a big statement.
Confused. OpenClaw sounds like Claude, but it's not Claude, but it was meant to sound like Claude, but now the guy works at, OpenAI.
It started as Claudebot, so it was actually built on Claude, and then a lot of stuff happened. It was really funny how OpenAI ended up getting the guy. But anyways, it's more than just OpenClaw. It's about sort of these agents that can function on their own. And if Jensen Huang and many others in Silicon Valley that are talking about this, if they're right, then AI agents are essentially a death sentence for the internet's middlemen. Here's why. The entire internet was built for humans who search, browse, compare options, they click on ads. An agent doesn't do any of that. It already knows what you want, or it figures it out in the background. So it doesn't browse 10 hotel sites or read reviews. It goes right from prompt to transaction. It might still access that data through APIs and data sets, but it skips the front door entirely. So the winners here would be the endpoints and the pipes. That's airlines, not Expedia, hotels, not Booking.com, your bank, not the nerd wallet that sits in between. So infrastructure, too, would be winners like Stripe, Plaid, and Shopify. Yesterday, Kelly, Box CEO Aaron Levy, he told us that agents need everything that an employee needs or a human needs, email, storage, and identity. And that could actually be 100 times their existing customer base. So that's not software as a service. It's software for agents as a service and could just be a huge market. That is why Jensen Huang called OpenClaw the most important software release ever, a personal AI that runs on your machine all day without even waiting for a prompt. That creator, as you said, just got hired by OpenAI, and the momentum here is unlike anything that we've ever seen in open source. The market is starting to sniff this out as well. You've got stocks like Twilio and Shopify. These are the plumbing that agents run on. They're rebounding big over the last month, and that is helping drive the IGV back from that.
Yeah, the moral of the story is here in regards to this whole situation, right, is there's going to be new incredible opportunities opened up, right? Whenever you get a new technology like this, a lot of people look at it from the negative perspective of like, oh, this might cause this company to lose market share. It might cause these type of employees to lose their job, right? And all these sorts of things. Every new technology throughout existence always creates so many new opportunities. It's unbelievable, right? And so I always take a look at it from the optimistic perspective, because it always is the one that ends up being correct. And there's never a situation where it ends up being the pessimistic situation ever. You can study throughout all business history and all innovation over time. Every innovation that ever came out, from electricity to the light bulb to the internet to, software, all these sorts of things, right? Hardware and semiconductors, they all end up creating incredible opportunities over time, and way more jobs that are produced, and a lot higher paying jobs than we'd ever seen before. I got a free resource for you guys. That will be the pinned comment down there today. It looks like I think we're up to 1,000 people or so have gotten this resource so far. Basically what it is, I put this together last week for you guys. It's like a test, and basically you go through and you kind of like check no, yes, like on how many of these things and it'll give you a result on if you're kind of like just a gambler in the market, or if you're like, in a place where you still got a lot to learn, but you're on your way, you're on the right path, or if you already are like a genius in the stock market. So it's a fun little test for you guys. Make sure you enjoy that. That will be the pinned comment down there, and then you know where you actually stand in this game. Big tech stocks don't know if they want to see momentum again. They don't know if they want to start going down. It was a great day. I was feeling great out there, so I was big balling. I bought the new Big Arch. You guys seen this burger? It's gone viral all over the internet. If you're on the internet, you might have seen it. The Big Arch. It's the McDonald's new product. I bought this baby. $10. $10 for this thing, okay? Entree only. We're not talking fries. We're not talking soda. It was $10 for a McDonald's burger. That thing was a beast, so I got to say. First person to ever eat a Big Arch in a Ferrari. I did make that happen. And a big thank you to AMD stock, Amazon stock, Meta stock, and Palantir. Those stocks performed tremendous today. AMD up $27,000 in the public count today. Amazon up $12,000. Meta up $12,000. And Palantir up over $6,000 in the public count here today. If I look at the retail trader investor type stocks, I have those on a watch list here. Man, where they beasting today. Coinbase up 14.5%. MicroStrategy up 10%. AppLovin up 10%. Robinhood up 8%. Palantir was up. Hims up. I mean, they were all up except one little dingo. That one, unfortunately, was down out of all of those. Now, look at Carnival Cruise Lines. They're going through it. This stock's down 13% the past 5 trading days. From what I hear, Carnival Cruise Line does not hedge their oil. So, oil price has gone insane. No bueno for Carnival Cruise Line. Even a stock like Wynn Resorts has gotten hit pretty hard the past 5 trading days, down over 4%. You might say, why? Well, that's because they're building an epic property in the Middle East right now that's supposed to open in 2027. With everything that's going on in the Middle East, now people are assuming no one's going to travel to the Middle East. Travel's going to be way down. Not good that Wynn's going to open their property there next year. We'll see about all that, but the market's running some conclusions there, and that's why that stock down 4% plus in the past 5 trading days. 3 core subjects I want to speak about here today in this one. Number 1, what to do and how to make money. I'm going to show you how to make money, even in a roller coaster of a stock market, even a stock market that downtrends. I'm going to show you in this video. Okay, we're going to go through it. We'll talk about how to handle this market from a portfolio perspective. Number 2, a stock I want to buy heavy. We're going to get into that in this video here today. And this one's not SaaS related. You guys know I've been buying a lot of SaaS stocks heavy over the past month or two. This is not a SaaS company, okay? Number 3, my favorite travel stocks over the next 10, 20 years. We know the boomers are all reaching retirement age right now. They got a lot of money behind us. We all know that. They're going to be doing a lot of traveling over the next 10 to 20 years, right? Also, a lot of worldwide wealth will be accumulated over this next 10, 20 years. That means a lot of travel. As people get wealthier, what happens is a lot more travel. So travel is definitely a great industry for the next decade or two. And so we'll talk about some of my favorite travel stocks in that space. One thing only I need from you guys. I hope you would appreciate me doing these videos almost every single day, Monday through Friday for you guys. One thing all I need from you is just smash that little like button, hit that thumbs up icon. If you could do that, that means the world. That's all I need from you. Everybody that's already done it, thank you so much. And additionally, if you want to be subscribed to the channel, I think you can subscribe. It is free to do so. And I believe we're at 920,000 subscribers. Are you subscribed? If not, make sure you go ahead and do it. Free resource for you guys down there today. That will be the pinned comment. This is a test I put together last week for you guys, okay? And what this is going to do, it's going to tell you where you're actually at. Kind of almost like a fitness test, but this is for the stock market. It's going to tell you where you're actually at in your investing journey, and like, are you doing great? Like, or you got a lot of work to do? And based upon how many of these questions, you can basically say correct, or you don't know it, right? You know it or you don't know it, that will give you the results here. Over 500 people have gotten this so far. I just shouted out here in the past like 24 to 48 hours. 500 people plus have gotten it. It's free to get it. It's pinned comment down there. Put in your email. It can send over the PDF via email, or if you want to receive it via text, can send it over that way as well. Okay. Alrighty, ladies and gentlemen, let's get rolling here. Listen. Look at the public count over the past 3 years, okay? Fidelity gives you a great little chart. You can see your portfolio over the past 3 years, right? And this is looking at the public count. Public count started this portfolio back in like 2018 inside my private stock group, so they can see every single move I make each week, see how I build this portfolio up over time. We built this portfolio from nothing to now $3.6 million just through Fidelity investments, right? And if you're part of my private group, you get to see the moves I make every single week in here, right? Now, look at the past 3 years. What do we see? It's been a tremendous past 3 years. 3 years ago, public count was just over $1 million, right? 1.2, maybe $1.3 million. And today it's $3.6 million. It's been a banger. But what do we also see when we look at this, okay? It's a big game of green light, red light, green light, red light, right? Where the public count will go through weeks or many, many months where it's downtrends or basically go sideways. Here in 2023, we had a good example of that. Here again, and this looks like 2023 again, another big example of that. Look at how much time would have passed here. Remember, this is a 3-year chart. Look at how much time will have passed here when the public count was doing nothing. And it's just week by week, month by month was going by, and it's like, dude, public count's downtrending or doing nothing, right? And we had a huge time period right here. Did nothing or downtrended. A pretty big time period right here. And then we had a big time period right here. This was during the tariff drama of last year. I'm sure you guys remember that. And now we're in another one of those big time periods when the public count's downtrending and not doing a dang thing. And so big game of green light, red light. And despite all those time periods when the public count was asleep or downtrending, the public count still went from a little over $1 million to $3.6 million where it is today. So the moral of the story is here, folks, focus on the long term. The short term will be what the short term is going to be. There's going to be time periods when your portfolio stagnates or downtrends for months, maybe even a year, maybe even 2 years. And you have to be okay with that. You have to say, I'm at peace with that. If my portfolio is stagnant for 2 to 3 years, I can take that. I'm a big boy. I'm a big girl. That's okay. That's fine. As long as you got your income and expenses in a good place, you're there to buy every single month, if not every single week or two, right? That's a big key. Always finding great deals in the market, taking advantage of those great deals, and be okay if your portfolio stagnates for a while. Don't freak out, buy the dip, and don't trip. It's an easy game, man. The stock market can be a very easy game unless you have no patience. If you have no patience, guess what? The stock market has no patience for you. Get out. You don't belong here. The ones that win in this game over time have incredible patience. If the public count is still $3 million 3 years from now, I'm okay with that. I can deal with that. I'm building the public count for the next 10, 20, 30 years. If the public count says $10 million 3 years from now, I'm okay with that. Whatever happens is what happens. All I know is I'm here to do my job, and my job is to buy great companies at great prices and watch them appreciate over time. I cannot dictate whether the stock market goes up tomorrow, next week, next month, whether we have a crash, whether we have a boom. It's going to be what it's going to be. I need to focus on what I need to focus on, right? When I was first kind of looking in the stock market, one of my dad's customers, he had a pool cleaning business, right? And so I remember she said, the stock market's like a roller coaster, right? I think she was a former financial advisor. She said, stock market's like a roller coaster. And listen, she was 100% correct. The stock market is like a roller coaster. Now, like a roller coaster, some people go on it and they say, that was fun. I really enjoyed that. That was a good time. I would love to go on a roller coaster again in the future, right? And some say, I'm never doing that. Some never even get on the roller coaster. That's not for them. Or they might do it one time, like, I'll never again am I getting on another roller coaster again, right? And that's fine. Some of you guys, most of you guys watching this video right now, you're cut out for it. You're ready for the roller coaster ride. You think it's fun. Other people, they're like, no, I can't do it. I can't. It's fine. It's not for everybody. I understand. I get it. Like, there's no shame in that game, right? Now, Warren Buffett, he's been investing for about 80 years now at this point in time. He bought his first stock at age 11, I'm guessing, through his dad, in 1942. Do you remember what was going on in 1942? I think it was something called World War II. Oh my gosh, there was that thing that happened, right? During World War II. Now think about all the craziness that has happened in Buffett's investing journey. From World War II to the Cold War to all the other wars. I mean, I don't even want to list them all. There's a lot of them, right? To 9/11, to Rona. I mean, gosh, you just go through all the craziness that has happened since Buffett bought his first stock in 1942. It's unbelievable when you think about just all the history that has happened since that time period, right? I bought my first stock during the great financial crisis. That was a pretty crazy time. Maybe not as crazy as World War II, but it was a pretty crazy time. Stock market was crashing, people were getting kicked out of their homes, and mortgage crisis. It was a mess. Biggest actually probably only real housing bust we've ever had in modern history in the United States of America. Like, that's a pretty much once in a generation event that happened there. Unbelievable. And there's been a lot of other crazy stuff that's happened just in my little investing journey. And I call it little. It spans 17 years, but it's little when you compare it to Buffett, right? And so just understand what ended up being Buffett's end result, right? Buffett's end result ended up being one of the richest people in the history of the world. You look at my end result of just what has happened over the last 17 years. Like, it's been incredible. Without the stock market, you think I would have the sort of homes I have and, drive the sort of cars and live the sort of lifestyle I have. Without the stock market the past 17 years, there's no way any of this is possible. Not without the stock market for me, right? Now, you want to know how to always make money in the stock market. I'll show you. Here we go, ladies and gentlemen. You want to always make money in the stock market, regardless if it goes up or down? Own dividend-paying stocks. There's a reason I talk about GVD, growth value dividends. Building a portfolio comprised of growth stocks, value stocks, and dividend stocks. All of them play their part at different times. If the stock market doesn't go up this year, I'm still going to make a ton of money from stocks. Do you know why? I own a lot of dividend stocks. This is just the public count. This does not include any of my private portfolios or the Patreon portfolio, any of that. This is just the public count. This does not include any of these companies that are going to up their dividends this year either, which many of these companies will likely up their dividends and pay me even a bigger amount than it says right here, right? Nike will pay me $5,466 in dividends this year. Cheesecake Factory will pay me $3,900 in dividends this year. Estee Lauder is going to pay me $2,497. Meta is going to pay me $2,100. Salesforce is going to pay me $1,760. PayPal is going to pay me $1,680. Good thing they pay a dividend, because Lord knows we can never make money on that stock, right? American Express pays me $1,170. I guess I make some dividends from my Tesla hedge, right? And Google McDougal will pay me $186, right? And so then you think about all my private portfolios and all the dividend income from that. I'll easily clear, what are we thinking here? Tens of thousands of dollars this year in dividend income between my different portfolios. Not bad. Not bad, right? Now, of course, this didn't happen overnight. It's been building for 17 years, right? In terms of all my portfolios, and then the public count's been building since 2018, so it's taken a while to get here. But the moral of the story is here, you want to continue to build and you want to make money regardless of the market conditions. Dividend stocks is your way. And guess what? If the market's downtrending and I'm making all this dividend money, I can go take that money and buy more great companies at very cheap prices. So this is a way you can definitely protect your portfolio and put you in a position where you don't just have to worry about income and expenses, right? Another way is hedges. Now, this might not be for everybody, but just understand there's ways you can hedge your portfolios. A lot of different ways. I have a great video inside the private group that, that video is probably nearly an hour long, just going into a bunch of different hedging strategies. One I'm utilizing this year is TSLZ, which is a 2x leverage against Tesla. The reason I'm using that is if the NASDAQ were to get hit hard in any substantial way, right, which might not happen, but if it were to, Tesla stock usually gets hit much more dramatically. This is 2x leverage against that. So let's say NASDAQ goes down 10%, right? TSLZ could easily go down 20 or 30%, because Tesla usually goes down much more than the NASDAQ during a downtrending market. And then your 2x leverage against that, I mean, it could appreciate 40%. Next thing you know, I'm sitting on tens of thousands of dollars of profits on this that then I can sell out of during a downtrending market and then pour that into stocks that are very, very cheap, right? So hedging, there's a lot of different ways you can do it. This is one I chose for this year. And hedges, a lot of times I end up making money from them. And if I don't, that's okay as well, because if I don't, it's usually the market went beast mode, went up substantially. And so it's like hedging usually is done with little money, and my big money's in long positions. So, net, it ends up being like, if you told me would I rather have the NASDAQ go down 10% or up 10%, I mean, well, if the NASDAQ goes up 10%, like my positions are going to appreciate massively. Public count probably goes to 4.5 mil, maybe $5 million in that environment, right? TSLZ, that'll likely go the wrong way. I mean, it's possible it still could go up if Tesla's stock was just being weak, but usually if the NASDAQ's going up, Tesla's going up as well. So yeah, you say, okay, I lose money on these, end up having to sell out for a loss. That's fine, because the public count would have gained $1 million or so, right? So, take some, give some, right? No, this is something I get a lot, right? So people say, how do you stay so calm during the market drama? And I see comments all the time when the market's going through drama about people appreciate the videos and it keeps them level-headed. And, because they're just going crazy about the market, especially for a lot of newer investors that are in their first year or two investing, right? Here's how I stay calm. One, I've been in the game 17 years. I've been through a lot of ups and downs. I started during the Great Financial Crisis. Keep in mind, during the Great Financial Crisis, the indexes fell 50+%. That almost never, ever happens. And I went through that. That's when I started, right? Crazy times. We had the Rona crash, right? The Rona crash was the fastest stock market crash in history. S&P 500 fell I think it fell 35% in a snap of fingers. It was insane, right? And then it was into a V-shaped recovery, right? We had end of 2018, which was very, very painful. We've had a lot of crazy stuff, right? So 17 years of experience definitely helps out immensely, right? And then all my studying of prior time periods also helps, right? And second thing is, I also stay calm because I got all my bases covered. I own great companies that make it through the storms, usually are in great income statements, great balance sheets, great cash flows. They're not like, oh, it's question mark if this company even makes revenue or they're going to go out of business or something like that, right? And then I own my dividend stocks, so I'll always have money pour into the portfolios. I got more income than expenses. I got some hedges. I got all my bases covered. Send the stock market up a bunch, great. Flatline the stock market, great. I buy more companies for cheaper prices, have the market crash, great. Then I get to buy stocks for insane cheap prices, and my hedges go insane. And all that dividend money pours in, and I get to buy during downtimes with dividend money as well. It's beautiful. So regardless, I got my bases covered across the board. Now, if you're a new investor, it's hard to get your bases covered all at once. You do that over time period. And all of a sudden, over a few year period, all of a sudden you're like, dude, I don't care what happens to the market, right? And you're in your first year or two, you get stressed. You're worried because you probably don't have your bases covered and you haven't been through it. You haven't been experienced enough, right? And you might not have seen the success, right? I've seen the success, right? I've gone on the vacations. I've lived in the homes. I drove the cars. I bought the things. I went to the fancy restaurants. I did it all. I've seen the success. If you're a new investor, you might not see the success yet. And so that makes you second guess it, right? Because you haven't seen it yet. Once you experience the success part of it, I think it all gets a lot easier. And so just, make it long enough so you can actually feel that part and you'll be like, oh, shoot, yeah, this game is pretty fun, right? Next thing up here, understand the market is short-term drama. I'm showing you seasonal patterns just from the past few years in the market. I see a whole bunch of drama there, right? A whole bunch of huge upward moves where the market moves up 6% in a month, right? I see some dramatic moves of market moves down 9% in a month, 8% in a month. It's a drama show, short term. But at the end of the day, the stock market is a huge moneymaker long term. We know that. It's a huge moneymaker long term. So just understand short-term drama, long-term success, right? No pain, no gain. No, I posted this inside my private stock group. If you ever want to apply, join my private stock group, by the way. That is always linked in the description area down there. I said, what do we do? I posted this a couple hours ago. I said, what do we do in a roller coaster or down market? 1, research work. Put in the work. Control what you can control. You can control if the market or your stock goes up short term. That's going to be what that's going to be. Put in the research work. You can control if you listen to conference calls. You can control if you're running projections on 1000xstocks.com. You can control if you're looking at valuations, if you're grading income statements and balance sheets. You can control all that. That's up for you, right? Number 2, buy more shares of great companies and increase ownership stake. Number 3, enjoy the ride and all the twists and turns. Do that, okay? When I moved to Las Vegas in 2015, I moved into this community, Summit at Sunridge, Henderson, okay? We moved into a 3-bedroom apartment. The apartment was around 1,200 square feet or so. At that time, I only had one child. He was about 1 year old, or maybe not even 1 year old, and moved in there with my wife. Now I have 3 kids, by the way, and lived in that apartment. Very close to that apartment was this unbelievable community. And I remember driving by this community when I'd go to the gym. There was a gym I used to go to. It was EOS Fitness. Okay. And in order to get to that gym, I had to drive by this one specific community. And it was just gorgeous. It had these homes on this mountain and they overlooked the whole city. And I just looked at those homes and they're just gorgeous, right? And looked into this community and it's just like billionaires lived in this community and people with such high net worths. And oh my gosh, it was just like guard gated community, just gorgeous, right? And, next week, I get keys to my house that I'm building right in that community, right? So think about where I came from in 2015, from that 3-bedroom apartment to now getting the keys to the house we've been building in that community. And took over a decade to do it, right? Didn't happen overnight. It was over a decade in the making, but it did end up happening in the end, right? And so just understand, it takes time. It doesn't happen overnight. But if you want to get to places, you gotta what? You gotta have patience and you gotta put in the work. If you don't have the patience, it's gonna be tough. It's gonna be a tough game for you. If you don't want to put in the work, it's gonna be a tough game for you. Okay. So just understand it's all out there for you. Whatever your dreams, whatever you want to succeed out there, whatever you want to do, right? For me, that was a big goal. Like I always loved that community. I always thought, man, it'd be amazing to have a house that overlooks the whole city, right? And now I'm gonna have one. And for you, it might be different. Maybe you want to travel the world. Maybe you want to retire early. Maybe you want to start a business and you want money to do that, right? Maybe you just want to take care of your family. It's a million different reasons why. But understand you can do it. You can absolutely do it. But it's going to take time and it's going to take a lot of work, right? Do keep that in mind. But always keep the faith. Always keep the faith. Number 2, let's talk about a stock I want to buy heavy. And no, it's not actually a SaaS stock because I have been buying those ones very heavy the last couple months here now at this point in time. Then we'll get into my favorite travel stocks. Okay. Certain companies have an unbelievable moat around those businesses. Okay. Unbelievable. Where these sorts of companies they're almost impossible to compete directly with. You can try, but they are you can't tear these companies apart. Let's say I started a retail store selling clothing. Right? Hard to have a moat around that. Let's say I come up with some genius strategy and it's really working. Like buy 3 pairs of jeans, get 2 pairs of jeans free. And I've priced them so perfectly that somehow I do this. Well, anybody can copy that and anybody can sell jeans, right? Walmart can sell jeans and Target can sell jeans and every department store in the mall can sell jeans. It's not, I don't have a moat around that business. And if my little hack is selling 3 jeans and you get 2 free, anybody that sees that can then go copy that same exact model, right? There's no moat around that business model. There's no moat, right? This certain company has an unbelievable moat, and it is AXP, American Express. I want to buy every share in sight of this company and hold it for the next 5-10 years. Now, to put it into context, how strong of a moat this company has, okay? I want to show you something that I think you're going to find fascinating. Do you know what Warren Buffett's second biggest investment is in his portfolio? It is a company named American Express. Now, Buffett is a very famous investor, not just because of his net worth and because of his success, but because of his understanding of a moat around a business and how a business can succeed for decades. Because Buffett is thinking about taking stocks to the grave, right? And I don't mean that just because he's like 90-something years old now. I mean, that's a way he's always thought about it. He thinks way longer term than even I do. I'm thinking about companies really for the next, I would say 3 to 7 years, right? Buffett's thinking about the next 37 years. There's a difference, right? He's like super duper long-term investor. I'm a long-term investor. He's thinking like Yeah. So when he buys a company, he's got to have looked in that business and had an understanding that they have a moat around the business that you just can't beat, right? And if you look at his biggest investments, gosh, they really do. Apple is just, sure, there's a lot of companies that make smartphones, but at the end of the day, Apple, we just know their moat is incredible, right? American Express we'll talk about more in a moment. Coca-Cola. I mean, sure, anybody can make, soda, but gosh, can you really compete with Coca-Cola and their distribution and their pricing and their marketing, right? And their install base, which is their customer base for those products? You just can't. Right? Bank of America, Chevron, like these companies are incredible, right? And the moats. Warren Buffett's, keep in mind, he's been deleveraging, if anything, or I don't want to say deleveraging, but selling out of positions, and yet he's still held American Express very strong as he owns 22% plus of the company. I wouldn't be surprised if Buffett starts buying more American Express stock. We'll see what happens, but I wouldn't be surprised if he ends up looking at it and being like, I got to buy more shares of this stock, right? Now, I wanted AI to show you guys how strong of a moat this is so you guys could really understand this, okay? And what makes American Express have such a strong moat and why this is a great company you can buy and hold for the next 5, 10, 15 years, right? Closed loop network and data advantage. Amex controls the consumer and merchant sides of the transaction. This allows them to collect valuable data on spending habits, resulting in personalized high-value rewards that attract affluent customers and consequently premium merchants willing to pay higher fees. Premium brand and affluent customer base. Amex has established a reputation as a premium brand with a cardholder base that tends to be wealthier and more resilient during economic downturns. This demographic provides high speed density, meaning lower credit risk and higher transaction revenue for Amex. 100%, right? If we think about when I lived in that 3-bedroom apartment in 2015 when I first moved to Vegas, guess what? I was not an American Express customer back then. Like, it just wasn't a company that spoke to me, right? Nowadays, I am an American Express customer. I have a gold card. My wife has the platinum card or whatever that is, and we're American Express customers, right? They understand how to market and how to get you once you make it, right? Whether that be to have a good job or whether that be when your net worth climbs immensely, right? Unique value proposition and ecosystem. The company invests heavily in perks, travel, dining, and entertainment. Guess what? Things that people with money like, right? This creates a high value ecosystem, making it hard for users to switch to competitors. This is reinforced by partnerships with luxury brands and businesses that want to access higher spending Amex clientele. Vertical integration issuer plus network. By acting as both the card issuer and the payment network, unlike Visa and MasterCard, Amex earns revenue from both annual fees interest as a lender and merchant swipe fees as a network, creating a diversified, robust revenue stream. Right? Because you can get a Visa card and you could be like, a credit card could be through many different companies, and you get a Visa card, right? It's a very different business model than somebody like a Visa or a MasterCard, right? And there's debates on what's better. Is it Visa? I actually feel like, believe it or not, Amex has a stronger moat around it than Visa, even though Visa is a much bigger company. But I actually feel like because Amex controls both sides of things, I actually think Amex has a stronger moat around the business. With over 150 million cards in force and a vast network, the system becomes more valuable to both parties the more it is used, which acts as a barrier to entry for new competitors. I mean, I use my Amex for basically everything. It's a pain in the butt if anywhere I can't use my Amex. And honestly, the only place I think of that I ever go to and I haven't been able to use my Amex is, guess where? Think about it for a moment. Costco. Costco is the one place. It annoys me when I try to use it at Costco and it's like, it doesn't work. I'm like, seriously? And by the way, back in the day, they used to have a very close relationship, those two. But yeah, now Amex, you can't use it at Costco nowadays. So it's very frustrating. But the moral of the story is, Amex, very, very powerful in the end, right? We're looking at 1000xstocks.com here. Look at American Express's revenue chart over time. Look at this is where we're at right now on a trailing 12-month basis on earnings per share. Look at where we're expected to go. Why? Well, the company's increasing their net income and will continue to for the next few years. Simultaneously, they're buying back a lot of shares, which means your earnings per share up and away. This is looking at American Express's, looking at operating income here, right? This is looking at shareholder equity here. Look at shares outstanding Shares outstanding for American Express, down, 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 down. That's what you want to see. You don't want to see this number going up when it comes to shares outstanding. That means you're being diluted as a shareholder. This means your ownership position's getting bigger, right? Obviously, balance sheet's very strong for the type of company it is, right? Forward P on the stock, 17. I think it's way too low. For a company with this sort of business model, I just think with the sort of moat around it, I don't think a forward P of 17 is right. This is a sort of company that should trade forward P in the mid-20s. Mid-20s. That's why I want to pick up every share in sight right now, because I believe this stock is very undervalued. Should trade in the mid-20s to maybe even potentially high 20s forward P, and we're down here at 17. So we're in the teens. Too low. Too low. Alrighty, next up here, let's talk about my favorite travel stocks. And we're thinking about these stocks really for the next 10, 20 years. Because the boomer demographic is all reaching retirement age right now. Some have already retired. Many are going to be retiring over the next decade, essentially, right? Specifically, really over the next 5 years, I would say, really heavy. These boomers have accumulated a lot of wealth. They have a lot of wealth in real estate. They have a lot of wealth in the stock market, and they also have a lot in T-bills, right? And bonds, just bonds in general, right? We all know that. The boomers are the richest generation we've ever seen. And, people like to make jokes about boomers bought, a home back in the day for a sack of potatoes, and now it's worth $500,000, right? Like, people make all these jokes about that, but they make those jokes because boomers are loaded. We know that. The boomers are going to go on lots of vacations over the next 10 to 20 years. Lots of vacations. Because what do? You got all this money, you're retired, play golf, go on vacation, go out to restaurants, stuff like that. Like, you're going to likely enjoy your money, especially while you still have health. If your health deteriorates enough, obviously, well, then you just end up spending money on healthcare, unfortunately. But for the boomers that are going to be in good health the next 10, 20 years with money, they're going to be going on a lot of trips and enjoying life, right? Living their best life. So what are some of the companies I really love? So my number one favorite stock in travel by a mile is this one. It is Wynn Resorts. It's not even close. Whenever you can get the stock under 100, it's a great deal. If the further you can get under 100, it's a steal deal, right? I love Wynn Resorts. It's a good combo of growth because they got the Middle East property coming online. Additionally, we're thinking about it in terms of a value dividend stock as well. It usually doesn't trade very rich, especially if you take into account, usually the PE ratio is not very high on the stock, but then when you take into account they have a bunch of depreciation and amortization in those numbers all the time that make the earnings look less. If you were to think about it more on an adjusted EBITDA basis, oh gosh, then it's really, really attractively priced. And keep in mind, they run all this crazy depreciation every year. Usually it's in the hundreds of millions of dollars, right? I can make a case that their properties don't even depreciate. I can make a case that their properties, if anything, are appreciating. Like the Wynn Palace, they paid, oh gosh, how much did they pay to build that property? I think it was $4 billion. I can't remember the specific number. $4 billion. I think the Wynn Palace is still worth $4 billion. The Wynn and Encore here in Vegas, I believe their total investment in those properties was $5.5 billion, I want to say. Maybe $6 billion. I think they're worth easily that today. And those properties were built back in 2006 and 2009 in terms of opening the door. Maybe it was 2005 and 2009. Those properties are still worth, in my opinion, just as much as when they were built, if not a lot more. Could you imagine trying to build and replicate the Wynn and Encore nowadays with today's building cost? How much more expensive everything's gotten, including the land cost on the strip? So that's a big factor I think is way overlooked with Wynn stock. Additionally, this attracts the high-end clientele, which I love. Now, obviously with prediction markets and Kalshi and Polymarket and all these things and gambling services online, all that stuff. You could look at a stock like Wynn and be like, I'm scared because people do a lot of online stuff now. Listen, man, Joe, placing a $10 bet on the basketball game tonight, he's just not Wynn's customer base, okay? Wynn's customer base, these guys are dropping big money, right? These guys are playing blackjack for $1,000 a hand, $10,000 a hand, right? There's a different level there. And those people that drop that sort of money, they don't want to just do it on their phone. They want to actually go to the place. Enjoy life. They want to be surrounded by beautiful women. They want to be comped at the best restaurants in town, right? Have meals that they couldn't imagine. Get bottle service at the club. They want to live the life, right? If you're going to drop that sort of money, you might as well go to the place that's going to treat you like you drop that money rather than just playing on your phone, right? And so you got to understand there's a different level of clientele. And I always tell people, if you really want to understand the Wynn and their business model, go to the Wynn. Stay there. go to the casino, go to the restaurants, and you'll start to understand, okay, this is a different way of living over here, right? And so that's what their properties really do. They cater to a high-end clientele. You're not worried about if these people are being hit by inflation a little bit, because that's not their customer base. The customer base is really, people that their customer base is really the top 10% of wealthy in the world and the top 10% of income earners in the world. That's Wynn's clientele base. And people that like to spend big money gaming. Because if you are the type that you like to gamble, right, the Wynn's the place to do it, because they're going to usually treat you the best and you're going to have the best experiences. And so, that's just bottom line in regards to that. And so Wynn's a great stock. Love that one. Love that one. Number 2 of travel that is my favorite is Las Vegas Sands. This one's not nearly as much of a favored one to me as Wynn is, but I still like Las Vegas Sands. They have some incredible properties, including the Singapore property, the Marina Bay Sands. That's a one-on-one property. That's what I'm hoping Wynn's able to do in the Middle East with creating a property that's just like, just is incredible, right? And that's really what they've been able to do in Singapore with the Marina Bay Sands. It's one of the most successful properties in the history of the world. And also they have a dominant share in Macau as well. Whereas Wynn's definitely successful in Macau and they make a lot of money and they got a lot of VIPs in Macau, but Sands is just a little bit of a different level in Macau when it comes to the amount of revenue because they have just so many rooms in Macau, right? And so I definitely like Las Vegas Sands. Once again, not as much as Wynn. Las Vegas Sands doesn't really have a strip presence anymore now at this point in time because they sold the Palazzo on the strip years ago and the Venetian as well to another company. So they're not really a player in Las Vegas anymore. And so it's kind of funny the company's still called Las Vegas Sands. But the moral of the story is Las Vegas Sands, I do like that one, just not nearly as much as Wynn. Number 3, I like Carnival Cruise Line. Carnival Cruise Line, now obviously this is not a stock that's going to be in favor right now because of the whole oil situation. And, if they're not hedging their oil, that could affect earnings over the next year. So just keep that in mind. But I do like it as a stock overall if we're thinking about it for the next 10, 20 years. Woo! We know the boomers. They love to go on cruises, and there's going to be a lot of cruises to go on over the next many years, right? Also, Carnival Cruise Line does a great job of being a budget-friendly cruise operator where a family can go on a cruise for honestly less than $1,000, right? And husband, wife, take the kids on a little, 3-day cruise or whatever, and you can do it for less than $1,000. And there's not a lot of vacations, and everything's included in that, right? You get the food, the drink, all that. There's not a lot of vacations nowadays that you can take a family for, 3 nights and do it for less than $1,000. It's just not, especially if you want a cool experience, which obviously going on a cruise is pretty cool. You're just, all over the ocean and go down to Mexico, likely out of Long Beach. You can do something out of Miami and go down to an island or something like that. It's hard to take a family on a decent vacation. And I think a lot of people have a lot of fun and kids have a lot of fun on those cruises as well. So they do a good job of, I think, attracting a lot of boomers that will be going on vacations over the next 10, 20 years and also doing a great job of attracting the kids. My number 4 is Royal Caribbean. Royal Caribbean usually has a little smaller dividend yield than Carnival and also trades a little richer on a PE basis than somebody like a Carnival. So usually I like Carnival Cruise Line better. However, Royal Caribbean does a great job. Their ships are incredible. And they also do a good job of attracting, I think, a little bit higher end clientele than somebody like a Carnival attracts, right? And so they're definitely a beneficiary as well. So they're probably my number 4. Outside of that, I don't like anything else in travel. I don't, Airbnb's okay. I don't really like it. The companies that like Booking and those sorts of companies, they're okay, but I actually worry about those potentially being disrupted a little bit by AI over the coming years. So, I just like those 4 companies. If I'm going to buy anything in travel, it's going to be those. But Wynn Resorts is the leader by a mile, in my opinion. Pinned comment down there is going to be that free resource. Take the test, see where you're actually at in your investing journey, and see if you're investing legend already at this point in time, right? 500 plus people have gotten it. You'll be next. That will be pinned comment. Public count, I just posted this on my X page just about, 18 minutes ago. Looks like about 6,000 people have gotten to see it so far. Public count has now turned green. for the trading day. Unbelievable move when you consider the market opened over 1,000 points down this morning. We are going to talk about a lot of stocks in this video, including stocks like AMD, including stocks like Tesla, MU, Nvidia, the big dogs, right? We'll talk about small cap stocks in this video. So if you love stock talk, you're going to love today's video because, we're going to talk about a lot of stocks here at the front of this video, okay? From there, we want to talk about seasonality and what to expect for the overall month of March and if this is going to be a good month or not for stocks. After we get done going through that, I want to react to this video from Tom Lee and his expectations for the market moving forward. And then I want to react to this video from 19 minutes ago. Volatility is here, okay? A lot to get into in this one here today, folks. One thing only need from you. If you don't mind, just smash that little like button, that little thumbs up icon. That means the world to me. Thank you, every single person that does that and doesn't even need me to ask. I hope you appreciate me trying to keep you guys up to date with everything going on out there. Try to point out some great opportunities for you and all that good stuff. And I certainly appreciate you guys and thank you for being subscribed to the channel. I also have a free resource for you here today that will be the main pinned comment down there, the very first pinned comment down there. It's a free checklist. I put this together last week for you guys. I let everybody know about it on the main channel last night on my new video I have on the main channel called 5 Stocks to Buy Now, March 2026 edition. But I wanted to give you guys access to this as well. It's free. You can send it over via email, via text, however you want to receive it essentially. It's a little checklist you go through. If you get 40 plus of these questions correct, you are looking very good. If you get 35 to 40, you're looking pretty good. If you get 30 to 35, you got a ways to go. You got a lot to learn. And if you get less than 30 on this, it's no bueno. You have a lot of work to do. So this is going to kind of let you know where you're at in regards to your investing journey, and it's free to access that. That will be main pinned comment down there. Second pinned comment down there will be for access to my private stock group, private wealth group, all the course curriculums, all that good stuff. Okay. Alrighty, guys. So let's get rolling here right off the bat. Let's talk some stocks. Do we want to do it? Let's do it. Okay. Listen, this market is unbelievable right now. We're starting to get a lot of volatility. I saw the VIX spike to around this morning. I believe the VIX spiked to somewhere around 27, 28 range, right? Which isn't like, this has never happened before, but it's definitely a very elevated VIX level. Very, very elevated, right? We have a Qs that's now down over 5% from all-time highs. So you're in what I would call a small correction, but nothing significant still at this point in time, right? Now, keep in mind, from those all-time highs, that happened way back around Halloween. Here we are in March now at this point in time. So we're in a market that's it's asleep from the perspective of the indexes just aren't doing much, right? It's down 5%, but it's not like it's crashing. It's also not like it's set new all-time highs. So this is a moment where a lot of retail investors, especially a lot of noobs in the market, they can get bored. They can get complacent. You know what I do during time periods like this, when the market's not moving up and you get 5% down in the Qs? You know what I do? I buy. I focus on loading up more shares of great companies. Increasing my ownership. You got to understand, for all the shares you buy in these stocks, you are increasing your level of ownership of that company. That's what I focus on during these times. So Qs haven't done anything since Halloween, technically down 5%. Perfectly fine with me. It's giving me an opportunity to buy a lot of great companies at very cheap prices and continue to add to my ownership position and building my ownership position bigger and bigger and bigger. How do you do that? More income than expenses. Number one key to investing. If anybody is watching this right now and you do not have more than income than expenses, that needs to be your number one financial focus in your life, bar none. That has to be your focus. For everybody watching this right now and you have more income than expenses on a monthly basis, you're doing great. Let's focus on getting that income even more up, baby, and then let's really start talking, right? Because that's when we start talking about the money starts to pile up. There's a big difference between somebody that can, let's say, put $2,000 a month toward stocks versus somebody that can put $200, right? You're going to build a whole lot faster at $2,000 a month, right? So Qs down 5% roughly from all-time highs. MU, this one has fallen quite a bit recently. Remember, MU has been on an absolute tear, but it is down quite significantly from where it was, right? I mean, this one was peaking out right around 440, now 381. MU, I think, is just a range-bound stock for the next several years. I think MU is going to be a range-bound stock kind of in that $300 to $500 range for years to go in the future. And so when people are feeling really bullish about MU, they'll bid it up to a 500 range. When they're feeling real bearish, they'll fall to around, right around here in the 300 range. And I think that's just where it's going to remain for years. Their earnings are going to be a banger. We know that, but it's already made such a ridiculous run that a lot has been priced in. On a 1 year basis, the stock's up 320%. Okay. AMD. So AMD, this one, everybody's looking at it and like, gosh, man, AMD is just weak right now. $190 a share as of right now, right? Significantly off those highs. The highs this stock reached was right around Halloween, once again, mid 260s, 264, 265, somewhere in that range. And then we got up there pretty close again around that 260 range back in January. And so AMD is just kind of floundering right now, but listen, man. Listen, regarding AMD, when this baby catches that bid, it's gonna fly. So like AMD could be dead money right now. It's just not doing anything. And I'm telling you, in a matter of 90 days, this stock could be at a whole different stratosphere. You're like, what? Why is AMD, $290 now? Like, I swear it was just $190. Like, and then all of a sudden 3 months later it's $290. I'm like, what happened? It's a momentum stock. When it doesn't have the momentum, no one wants a piece of it. And then all of a sudden, momentum starts to build, the hype starts to build, the excitement starts to build, and the stock just goes on a ripper rally. And so with AMD, I think that next guidance is going to be very important. So their next earnings will come out in AMD's next earnings is probably about a month and a half from now, maybe a little less. When their next earnings comes out, let's say it's ahead of expectations, but the guidance is really, really strong. Let's say they take up their full year expectations versus what they were expecting. Get ready for a rocket ship ride. And you'll see that stock go from 190 to 290 in a snap of fingers. It's a momentum stock. And that's just what AMD is, man. Okay. Tesla Model continues to be weak right now, but the Qs are weak, right? And so as long as the Qs are weak, Tesla's going to remain weak. If the Qs really weaken, you got to understand the more damage in the Qs, the more like the extreme damage starts in Tesla. Like this one hasn't even seen really extreme damage yet. This one is quite a bit off those all-time highs of around, we can call it 490. It's now at about 390. But Tesla, a lot more damage ahead if the Qs get hit harder. Now, if the Qs bounce back, then I don't think Tesla's going to do great in that environment, regardless, because the SpaceX IPO is likely coming this year. And that's going to funnel a lot of money out of Tesla because we're going to have the new exciting thing. Momentum traders are going to want to play SpaceX rather than Tesla and all those sorts of things. Okay. Snowflake continues to be a really weak stock. Like, look at this, baby. This was 277 just back in November, now 166. Their problem is their bottom line. Their expenses is still ridiculous. Avago's significantly off those all-time highs as well. This one reached all-time highs around December, 413. It's basically lost about $100 a share. Nvidia continues to flounder despite just ridiculous numbers, man. Just ridiculous. I mean, look at this stock. We can go back to August. We can even go back to July. It's roughly around the same range it was July of last year. And that's despite Nvidia's numbers being phenomenal. But it's just, it priced in a lot. And then additionally, people are kind of thinking about Nvidia in terms of like, hey, the growth rates are going to slow substantially as this year ticks on. And so like the highest growth rates you're going to see is this quarter you're about to see in terms of revenue growth percentage rate, right? Then it's going to get less, significantly less the next quarter, significantly less the next quarter, significantly less the next quarter, right? And so that's just one of those things. It's hard for growth investors to get excited about it. And value investors are having trouble stepping in Nvidia because they don't know how sustainable all this is, right, in regards to chip spending. So the value investors are scared. The growth investors are looking and they're like, oh my gosh, the revenue growth percentages as 2026 goes along are going to decrease substantially. And it leads to this kind of overall malaise in Nvidia, and that's what we have going on, right? Google McDougal. And so Nvidia just kind of, like I said, I made this prediction, I think it was last year. I said this stock will just remain kind of in a 125 to 200-ish range, for a few years. And so that's kind of what I see happening here. People will get bullish around the Qs, bullish around Nvidia. You'll see it bounce up to that $200 range. People feeling bearish, Really bearish around it, they'll send it down to kind of 130, 125, 140, somewhere in that range, right? Google McDougal, so this one's really starting to flounder. This one reached highs just about a month ago at 344, now down to 302. Google McDougal, listen, they're executing well. They've proven they're at the forefront of the AI revolution. And, it's just a stock that it's a great company. It's priced in a lot. The move has been extreme, right? On what is this? A 1 year basis, the stock's up, 79%. It's had a massive move. And so Google's I think it's just kind of chilling right now. And that's just what it is. There's no other, it is what it is. Oracle, this stock cannot catch a bid, man. It's just a devastating stock. It is down 8% over the past year. It's obviously down 1.5 miles from these highs it reached back in September. 327, 330, somewhere in that range, and it's $148. I've considered Oracle recently because I'm like, gosh, the stock's down so much. But I don't like their balance sheet. I do not like their balance sheet, and they're going to have to take on that balance sheet is going to have to get worse over the next couple of years here. And I'm like, do I want to hold an Oracle even if I think they have a good revenue opportunity over the next few years? If I think the balance sheet's going to be even messier, I value balance sheet a lot, and they just don't have it. So we'll see. Amazon is amazing. Great company. Obviously, people are just worried. Amazon and Meta just can't get any momentum because of what I told you guys, I called this out, a couple months ago now at this point in time. I said the issue with the Amazon Meta, and these are two of my biggest investments and will remain two of my biggest investments for years to go in the future, but they're just going to have trouble getting any momentum in the short term. And as a long-term investor, I'm not going to flood out of them because they might not be able to get momentum in the short term. But the bottom line is here, massive depreciation is coming over the next few years because all the chips they're buying right now, they're going to have to depreciate those. It's not an ideal situation. Netflix, good news for Netflix. I mean, if they're not doing that deal, that's the best news ever for Netflix, in my opinion. Them doing that deal, I don't think it was good. No bueno, okay? Uber's just a stock that I think they're a big money maker next couple of years. I think their profits are going to be tremendous this year, next year, probably even in 2028. But listen, with Uber, there's no doubt they're going to be disrupted in a massive way over the next few years. Like the Tesla Robotaxi network will take off over the next few years, right? Obviously, Tesla's already priced that in and some. Waymo's continue to expand city by city by city. And I think, Tesla and Waymo are going to be significant competitors. And then you have Zoox, which is backed by Amazon. And so here in Vegas, we're starting to see a lot of those. They've started to release a lot of those vehicles here in Vegas. And so you're going to have major competition from Tesla, from Google Waymo, right? And you're going to have, and keep in mind, this is ugly, because Google and Amazon are loaded with money, right? They're loaded with money so they can really invest in this robotaxi type opportunity over the next few years. Tesla has to have this. This has to be big for them. If this isn't big for Tesla, Tesla has nothing else going for them. Literally. Their vehicles aren't selling well, just factually. Like you've seen the numbers over the past few years. It's disaster. Like they should be growing at exponential rates. And they're like, volumes have been going down the last few years. Like it's horrible. And then, Optimus robots, that's still years and years away. That's not even really a story, in my opinion, until the 2030s. In terms of being any significant revenue driver for Tesla. So we're talking really for the next 5 years, they have to be successful at robotaxi. And so you got a company there that is like life or death, that they succeed here. And then you're going to have to fight Google, and you're going to fight Amazon to have unlimited resources. And Google's very focused on this with Waymo, right? They've been focused on this for the longest time. It's a huge opportunity for their business model. Woo! I wouldn't want to be Uber. The good thing for Uber is they got Uber Eats, right? Which is, I think, a very good thing for them. They have their subscription plan, but gosh, the rideshare is just such a big business for them. No bueno. I mean, if you told me I had to buy DoorDash stock or Uber, I would honestly buy DoorDash out of these two. And keep in mind, I wouldn't want to buy either one of these. But let's pull up Uber's numbers here, and let's pull up DoorDash right next to it. And let's take a peek here. So DoorDash, 2-year forward P is 31 in the stock. Uber's about half that, right? 16. But I feel, as far as the business model goes, I feel so much more secure with food delivery over the next 5 or 10 years versus, I think Uber's in a tough spot, man. I really think they're in a tough spot over the next few years, okay? But when I say in a tough spot, it's like they're going to make crazy profits over the next few years while their business is very, very disrupted. And that makes it a weird situation. Palantir valuation got insane. Obviously, I spoke about that many times as a reason I sold the far majority of my Palantir shares last year, right? The valuation went ridiculous. I mean, it's just out of control. And so it's obviously had to pay the price for that. And so great news is the numbers are great. The other issue is with Palantir, we're going to likely have revenue growth percentages start to go down. Where for Palantir, it's been a really exciting cycle where the revenue growth percentage goes up, 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 up. We've likely peaked now, and the revenue growth percentage is likely going to start going down. So, if it doesn't start going down this coming quarter, it'll be next quarter. But it's almost like, I would say like a 99% guarantee within the next 1 to 2 quarters, Palantir's revenue growth percentage will start to decelerate. So they went from like 73% revenue growth to like 65% or 60%, and then it'll go to like 55%, right? And so that's something growth investors and momentum investors look at heavily. And so they don't really want to partake in a stock usually, unless you're in a full-on risk-on market, then they'll look the other way. But usually growth investors don't want to be in a stock where the revenue growth percentage continues to decline. That's something Nvidia has going on, right? So it's not like Nvidia numbers are bad. They're phenomenal. They're amazing. But the revenue growth percentages it's declining there, right? Mr. Softy's valuation's gotten attractive. Gosh, has Microsoft gotten attractive here recently? Keep in mind, Azure growth is 38% last quarter or something like that. Look at this. With Mr. Softy, a 22 forward P on the stock? Come on. It's incredible in regards to Microsoft. So, goodness. Look at current year expected earnings per share growth, low double digits. Next year, mid double digits. Revenue growth expectations, 16% for current year. Next year, 15%. Man, that's a hard one to just be like, not going to buy it. Very intriguing. Shopify. This one's gotten Shopify'd recently, right? Reach a peak there about 178. Keep in mind with Shopify, listen, regarding this stock specifically, 2 things you got to know about Shopify. 1, great company that's a growth beast. That's the first thing you got to know about Shopify. There's a reason I own this stock as an important position in the Patreon portfolio. If you ever want to join my Patreon, it's always linked in the description area down there, along with my X page, and along with also if you want to apply, join my private stock group, right? The other thing you got to know about Shopify stock, it's very important. Everybody understands this that's watching this right now. When you're in a risk-off market, no one wants to own Shopify stock. No one. When you're in a risk-on market, people want to take risk. Shopify is one of the best stocks you'll find in the market. And there's a reason you watch this stock go from $25 a share in 2022, right, at its lows, to 3 years later, trading up near 180. You're in a risk-on market, and everybody wants to own Shopify. And when you go risk-off, which is certainly what the market's gone, right, you all of a sudden get a lot of damage. You go from 180 down to 120, and at the lows here down to about 110. And if we pull up a 5-year here of Shopify, look at the stock was around 170. We go super risk off on the market, right? And it goes all the way down to $25. From 170 to 25. And then from 25 to 180. And now from 180 to 120, right? So understand that about Shopify. It gets Shopify. It looks like software stocks have bottomed, but let me push back against this for a moment, okay? Because CRM now, all these stocks are starting to appreciate. just in the past few trading days, I would say, right? So let's pull up like a 5-day of Salesforce. Let's pull up a 5-day of ServiceNow. And let's pull up a 5-day of Adobe. And let's also pull up the, IGV, a 5-day of IGV software index. So you can see clearly like these babies have started to move up, right? ServiceNow's just in the past few trading days up 12.8%. Adobe's up 7.8%. IGV's up 7.2%. Salesforce up 6%, right? So it looks like these ones probably have bottomed, but the one disclaimer I'll put on this is there's a potential that if the market was to go lower, the whole NASDAQ, the whole S&P 500, it could pull these down for one last hurrah down move. So I just wanted that to be a disclaimer. If we don't get that one last hurrah move down for the NASDAQ, for the S&P 500, where the Qs end up going down 10 or 15% or something like that from like the 5% range that it's at right now. If that doesn't happen, these stocks have probably bottomed. If that does happen, we got one last hurrah move down, and then we'll set in the baseline lows, and then we'll start to move up from there. And keep in mind, it's not going to be every stock, and some of these are going to way outperform other ones, right? Somebody like a ServiceNow is obviously a big outperformer so far. So it's not going to be all of them, but there's a good chunk of them that have been severely damaged, and value investors are starting to step in with these stocks. Keyword is starting. They're just nibbling right now. There's a lot of buying to happen in these stocks likely over the next several years, so do keep that in mind. Let's go ahead and take a look at my stocks here today. So Honest is my best performer here today, 284. That stock is up. That's a very volatile stock. Honest is a very, very volatile stock. It has huge moves. I think the company sets up so well for the remainder of this year and over the next several years. But gosh, it's been a tough one. It's been a tough one. But the business fundamentals are just getting better and better and better. We're talking about, they're talking about adjusted margins this year higher than we've ever seen, basically in the company's history, at least in any sort of modern history for this company. Balance sheet's a beast, huge buyback. I did feature this stock on last night's video on the main channel. If you don't watch my main channel, it's called Financial Education. It was one of the 5 stocks I featured in 5 stocks I'm buying now, March 2026 edition. Okay. So pretty good opportunity as far as that goes. TSLZ. So in regards to this one, obviously this is my short-term hedge on Tesla, my Tesla, and it's starting to perform well. We're now up on both my positions in the public count for this. I'm kind of waiting to see if we get some more damage in the Qs, more damage in the SP 500. If we do, I'm going to end up cashing out of that and moving that money elsewhere, right? Adobe, we spoke about them and kind of software stocks already. Shopify, spoke about that. PayPal, getting a little momentum. That's good to see. Those reports about, PayPal might get sold. PayPal might not get sold. There's always reports about that, right? I think there is something going on under the surface right now, PayPal. I think companies are going to deny it. No one wants to admit they're looking at PayPal. Why would you want to admit if Stripe comes out and says, oh, no, we're not looking at them. That's what they should come out and say. That's what they should come out and say. You don't want anybody to know you're looking at PayPal. You're thinking about potentially buying one of their businesses or the whole company. You know why? Because it's going to push the price up. And then you're going to have trouble getting it approved by the board of directors. You want PayPal stock to stay low right now. Stay in the 40s. Then get everything worked out. Come in with your number. Maybe it's 70, maybe it's 75, maybe it's 80. And it makes approval a lot easier. Let's say PayPal stock starts to run. Next thing you know, the stock's back in the 60s, right? And you come in with a bid at 70. Shareholders might not vote that to get approved. You know why? Because then they're like, we're only getting a $10 premium? No. However, you have a stock that's in the 40s and you come in with a 70, 75, $80 bid. All of a sudden it seems like, whoa, that's insane. That's like a 60, 80, 100% premium depending upon where you're trading at. So I think there's things going on beneath the surface at PayPal right now in regards to these talks. I could be wrong about that, but I think there is. And I think we're starting to see some of that in the price momentum there. Palantir, we spoke about that earlier. SoFi continues to kind of be a flounder stock. It's performed well over the past year, 37%, but there's another one down huge from the highs. Highs at 32. It's trading at 18. You know, I think it's a great buy. I think it's a great opportunity. But, you know, there's always risks that comes with SoFi. There's more risks that comes with SoFi than an average business because they're banking related, right? And so some loan risk they'll take on. A lot they try to outsource. But at the end of the day, there's risk that always comes with a stock like SoFi. Cake continues to perform well regardless of what's going on out there as a great stock. Revolve's a banger. American Express has been hit heavily recently. This one I love as a buy. This one reached highs at 380s range just back a few months ago, and it's 307. Huge discount on American Express. This is one of those companies that I feel very comfortable, you know, buying this stock and holding it for years to go in the future. Years. Look at the forward P, 17. I think this is one of the safest, best business models in the world. How do you disrupt American Express? Literally, how do you do it? Is AI going to magically disrupt it? Of course not, right? And like their customer base is just sticky. Like they pay to use those credit cards. Guess who's a customer of theirs? I'm a customer of theirs, right? I think it's a gold card. My wife has a super expensive card because I guess you get access to more lounges and stuff like that. The card that's like $900 a year or whatever. So like American Express, like that's just a business model that's hard to disrupt. Like you can't just come in and you know, beat them and offer all the things they're going to offer and try to steal them and their network effects, their marketing. I mean, geez. They've got it, man. They've really got it. And so trading at a forward, I almost look at them as like a McDonald's type business model where it's just like, good luck, you know, good luck trying to beat them at their game. They're just dang good at it. So, you know, we're looking at a stock here that next year revenue growth, talking about 9%-ish. Next year earnings per share growth, 13+%. I really like American Express. Very underrated stock in the market. Spoke about Amazon. Elf on a Shelf is a great banger of a stock. You know, this one's another volatile one. Look at the past year. It's up 27%, but it's been everywhere. I mean, the stock has lows of $49 and it has a high of $146. And right now it's at $81. So this stock has been everywhere and in between for the past year, right? It's a roller coaster ride. However, it's one of the best stocks in the market if you can get it at the right price. One of the best stocks out there. I believe this is a $200 stock in the next few years. And so it's a huge buy here today. I should buy some. I should have bought some today. I'm kind of mad I didn't. I should have bought some stock. I'll probably buy some Elf in the next few days. I should. Like, it's just a steal deal. We spoke about Google McDougal. Wynn Resorts. So this is one I let my private stock group know about recently here. So, yeah, and it's down significantly just in the past few trading days. I mean, the past few trading days down about, oh, look at that, 7.77%. That means it's a great buy. We'll come back to this in just a second. But I posted this a few days ago in my prep stock group Discord chat. I said, Wynn could be down big in the morning. This is back on March 1st. I posted this. Due to Middle East mess, since 2027, Middle East properties coming. Market could run to conclusions that the Middle East travel will be dead for a while. And so that's just something, you know, that has to be dealt with. And so, you know, the thing is, like, the world moves fast. Like, you know, I understand right now this is a topic of conversation. Everybody's talking about it, looking at it. But, you know, a year from now, like, who knows? This could be old news or maybe it's still ongoing, right? Maybe it's worse than ever. But all I'm saying is the world moves fast, and, you know, don't be surprised if people forgot this even happened a year from now. I mean, there's things that happen on the market all the time that it's like this huge thing. Everybody's talking about it. And then like a year or two goes by and you're like, wait, when was that? I remember that. What was that about? Oh, yeah, I remember that now. You know, it happens all the time. EL Estee Lauder, great buy here. Under $100 on EL is a steal deal. Just always keep that in mind for Wynn and Estee Lauder. If you love those businesses for a long-term basis, right? Which those are businesses that do great generation after generation, year after year, right? Estee Lauder with their high-end beauty brands, and then Wynn Resorts with their high-end resorts, and obviously Las Vegas and Macau, and then they got the one they're building in the Middle East. I mean, those are just, you know, great bangers of stocks. Anytime you get them under 100, you have to buy. if you can get, the lower you get them under 100, you have to load the boat, basically. Okay, so that's those stocks. Nike here at 59, great value, great deal. We spoke about AMD earlier. Celsius under 50, I love it. So those covered those stocks there. Housing stocks, let's see what's going on with housing stocks. Whoa, Whirlpool's down to a 60. Oh, shoot. Oh, shoot, this has me intrigued. 60? Shoot, it's down to 60? Oh, man. Listen, washers, dryers, and appliances are boring, but shoot. Whirlpool down to 60? Oh, man. I might have to step in. Because here's the thing. I believe, this is my personal belief, okay, based upon everything I look at. I believe we're bottoming out the housing market as we speak right now, okay? I believe it can't really get any worse than it is in regards to volume, right? Pricing can always move around, but in terms of volume, just like no one's moving. No one. Like, it's awful. We're like at great financial crisis, if not worse than great financial crisis type numbers. Like, no one's moving. Worst thing ever for business models like Whirlpool and appliance makers, right? You need people to move. When people move, okay, now they start considering buying a new washer, new dryer, new refrigerator, new oven, this and that, right? And, like, this is what happens. I think we're bottoming out the housing market right now. And I think the housing market starts to unfreeze as this year goes on, and it gets even better in 27 and even better in 28, which I think is going to be a great thing for Whirlpool. So I'm looking and I'm like, gosh, the stock is $60. I mean, it's just not the most exciting business. We know that, right? But shoot, I kind of want a piece of Whirlpool. Do I not? Man, that's a tough one for me. That's a tough one. If that goes in the 50s, I might have to do something there. Yeah, AI is not disrupting that one, right? RH is down 155. Oh, shoot. I've been tracking RH recently. 155? Dang. Ooh, shoot. But that's the thing. Would I rather have an RH or would I rather have a Whirlpool? Those two companies have very different customer bases, right? To give you reference, I got a house being built right now. We just spent money on furniture for the new house. We spent $200,000 with RH. $200,000, which I think we're going to charge all on the American Express credit card. So if you're an American Express shareholder or RH shareholder, be sure to give me a thank you for that, okay? I'm intrigued. Oh, I'm intrigued. My big thing is, would I rather have an RH or would I rather have a Whirlpool? It's tough. Oh, man. I could just split let's say I actually come in with buys for these stocks. I could come in with I think I might have to do it. I might have to put my foot down and do it. Listen, man, I truly believe we are bottoming out the housing market volumes right now, literally right now, like in the first half of this year. And I truly believe that over the next several years, the housing market heats up. Like, I think 2-3 years from now, we could be talking about a hot housing market again, where like people are moving left and right. And right now, no one's moving. And I'm just like, gosh, people moving is the best thing ever for companies like RH and companies like Whirlpool. That's a tough one. Now you may say, why would I be interested in somebody like an RH or somebody like a Whirlpool versus a company like, let's say, a Toll Brothers, right? Well, Toll Brothers hasn't been hit like those stocks have been hit. RH, a few years ago when their business model was flying high, that was a $700 stock. It's $155 today. Whirlpool used to be a stock that was like $200, $300, right? A few years ago. Let's see, Whirl. Yeah, there's a stock when the housing market was red hot back in 2021, right? $250, $60 here today. So those stocks are not equal in terms of, being hit. Additionally, when it comes to somebody like a Toll Brothers, the issue for Toll Brothers, and this is very important, everybody understands this, if the housing market heats up over the next 2 or 3 years, right? We bottom out this thing and it gets better over the next 2-3 years. That doesn't mean great things necessarily for Toll Brothers, because that could mean a lot more active listings from existing inventory, right? And so you get a lot more momentum in there where people aren't looking at new homes necessarily as much. And keep in mind, these new home builders have done a lot of incentives and a lot of tricks and games with the whole mortgage rate buy downs and things like that. That might not be as important if we can get this 10-year down into the 3s and we can start getting mortgage rates more into the 5s. I just locked personally at 5.75. So I was a good rate, and I was like, I think we locked last week or the week before. It's a very good rate for the time period we're in. Obviously, if you compare it to versus my other properties that are at 3%, it seems insanely high. But for recently, like 5.75, you'll take down on a 30-year fixed, right? Man, I'm thinking RH, I'm thinking Whirlpool. Shoot, man. Shoot. I might have to do it. We'll see. We'll see. Oh, man. Big tech. Oh, this is where we started at. We started on the big tech watch list here today. See retail trader type stocks. HIMS continues to just be in a tough spot. $15 on that one. Micro Tragedy continues to be just in a tough spot as well. Down to 132. The hood continues to kind of be in the hood. $76 on this one. Their business model's improved so much. It's in like night and day difference. Little Dingo came back to $100 plus, so that's good for Little Dingo there. Alrighty, so that wraps up stock talk. We don't need to get into any more than that. This I want to show you guys before we react to Tom Lee in this other video here. So I posted this inside my Prep Stock Group's Discord chat. Once again, if you want to apply to join my Prep Stock Group and you want to get your membership cards, your 1000X membership card. Ooh, look at that. This is a 2024 edition, by the way. You want to get your private stock group. Oh, and this is a 2026 membership card, your Steel membership card for the private group. And if you join us on a lifetime basis, you get the black card. Ooh, this one's beautiful. Oh, beautiful as well. You get all 3 of those cards when you join us on a lifetime basis. But I posted this. I said, it shouldn't. What I'm going to show you here, it should not change your perspective as a long-term investor, right? You stick to your strategy, but it is worth at least being aware that factually, March has been an insane month the last few years. I mean, absolutely insane. Look at this. This is an S&P 500 move. 2022, March was up 3.5%. Keep in mind, 2022 was a trash year for the market, but somehow March was a great month. 2023, great month for the market. 3.5% gain, and then 3.1% gain in 2024. Then last year, obviously, we started to have the whole Liberation Day drama and all that stuff. That didn't come till April, but there was already like a lot of drama before we got to that date, right? The March move was down 5.75%. These are huge moves for a 1 month basis of the S&P 500. These are huge moves. So just keep in mind, March is probably going to be a really good or a really bad month. There's not a super high probability it's going to be just a boring month. It's going to be drama filled, and it's, just something to be aware of when you're going into a month. But like I said, stick to your game plan. I stick to my weekly buys. I'm going to be buying stocks this Friday. I bought stocks last Friday. I buy every single week inside my private group. All of the members get to see that. I buy every single week in my Patreon portfolio. All the Patreon members get to see that, right? And then I buy every single week, every single Friday, as long as the market's open on a Friday, in my private portfolios as well. So I just execute, regardless of if it's a crazy month. It's just good to be mentally prepared that March is crazy, man. It's a crazy month. Tom Lee,
the CNBC contributor, could be down, obviously, a lot more Straits of Hormuz maybe in play at this point. In past incidents like this, and every single time it's happened, we've always said, well, in past incidents, it never lasts that long, and decisions that are made about whether staying in or getting out of a market, normally standing pat has been the right move.
That's right.
I'll tell you how the market's looking at this, okay? Listen. The market's looking at this very similar to how the market looked at the government shutdown back in the fourth quarter of last year. It kind of thought like, it's not going to happen. And then it was like, well, if it does happen, it's going to be short-lived. And then it kind of kept going on, and we started to have some actual real weakness in the market, right? And so that's what's happening in this situation. I think the market's trying to look past it as it's like a short-term thing. But the longer it goes, the more you could have problems. where people start getting scared about, oh, this is being a prolonged thing. This isn't just some quick little in and out thing. Then people start to worry about oil prices if those continue to go up. Yeah, you can get a lot of worries really quickly here. So, it just piles.
I mean, nobody likes to see headlines and the images of explosions and war. And so we know risk premium jumps. That's why the VIX jumps. But it's not really going to change the fundamentals of the U.S. So in the past, markets kind of sell off into the buildup, and then they tend to do better once the battle begins. And I think this is going to be similar.
We got to watch across the board, obviously, gold and the yield curve, but as in oil, obviously oil, but it won't affect us in the economy at this point. But I guess there's a scenario where down the road it could, isn't there?
Yeah, I mean, I think a lot of experts are going to worry that this could, encompass a larger conflict. Something that would be, World War III or something.
Right.
But in the absence of that, I think the worst of the sell-off is going to happen this week. And, I would expect actually March to be an up month for the stock market.
What about the price of oil, which has been such a huge benefit, lower prices of oil to the economy?
Big statement by Tom Lee, expects March to be an up month for the stock market. Big statement.
I realize that we are self-sufficient, but a lot of other countries aren't. If you look at China, if you look at India, Japan, is there a point?
Oh, and by the way, something important with that whole seasonality trend, listen, just because if March is a great month or a bad month, don't run to the conclusion that, it's going to be a great year or a bad year. For instance, 2022 was a bad year for the market, right? S&P 500 was down about 20% for the year. Trash year, and yet March was a great month. Meanwhile, look at last year. Last year was a great year for the market, but March was certainly not. S&P 500 down nearly 6%. Oh my gosh. It was by far the worst month by a mile that happened in 2025, and yet it ended up being a great year for the market. Not only was that was one of the worst months, period, we've had. Actually, that was the worst month we had in the last 3 years, ladies and gentlemen. And yet, it still was a great. So just don't run to conclusions. If March ends up being a really bad month, don't think the market's doomed for the whole year. If March ends up being a great month for the market, don't assume like we don't have pain potentially coming later in the year or something like that. Just don't, run to conclusions, because a lot of people do that.
It gets more expensive, and if it gets more expensive for China, that is then exported to the rest of the world.
I mean, oil's going to create a price shock because oil, it ends up so much in the economic supply chain.
Even what we produce here is going for 72 now, so it doesn't matter whether we got plenty of it, but oil companies are obviously going to reap some benefits, but consumers, this will filter through in a time when we're still inflation phobic, I think.
That's right. In the past, oil shocks are actually more at risk of maybe tipping a weak economy into recession.
And that's not where we are.
Yeah, and so I think instead of thinking the Fed would be hawkish, I think the Fed might be dovish on a spike in oil.
This market is not doing things that you didn't think it might do at the beginning of the year. And it had nothing to do with what the developments of the past week. Block. That makes people think AI is... They were underestimated. Unless this is the same guy that had 3 times as many at Dorsey, 3 times as many employees at Twitter as was necessary to run that.
Exactly. Yes, exactly. And it's like, look at a company like that. It's like, do they really need that many employees? Oh, wasn't there, they changed their ticker symbol. Yeah, there it is, XYZ. So when it comes to this particular company, here's the issue, right? Square used to be a huge revenue growth company, huge, back in the day, and now they're not. So to have a massive amount of employees when you're having trouble growing the business by any substantial way, right? That trailing 12-month revenue growth, that's crazy. Let's pull up a charts feature on Square here, and let's take a peek, because this used to be a few years ago, this used to be a very high growth company. Oh, look at that. It was great growth, and then look at how this is just put me to sleep. Listen, you have a company that flatlines like that, you have to cut a lot of employees. You should need the sort of employees you used to have, right? Which makes you think, if Square's doing this, you don't think PayPal could come in and do a huge, think about this. Think about the profits PayPal makes right now. Imagine if PayPal comes in and does a 30% reduction in workforce. Do you know what type of profits we're talking about? What type of margins? PayPal's not growing the way they used to grow back in the day. They're hardly growing that business. So do you need that many employees now? Right? Yeah. Look what's happened in their profitability here recently. So there's no doubt it definitely feels like the type of company that needed to cut employees. So that's what they did there. So don't run to conclusions that all of a sudden every company needs to cut massive amounts of employees. It's just like, that was a super high growth company a few years ago. They're not anymore. It's clear as day what's going on with that business. You got to come in and you got to cut employees. Just bottom line in regards to that.
So I don't know whether you general paint a broad stroke about AI with what happened there, or whether this is a one-off. I tend to think we better get used to this, no?
Yeah. I mean, I know many companies that are rolling out AI workers. Even at Fundstrat, we are deploying these agents and, treating them as if they're employees. But I think we're still unsure whether or not this will ultimately create more jobs or not.
And AI is will kill a lot of companies. And AI itself, the killer is, you could say, had such a run that it is at least richly valued.
Yeah. And, at least in the case of the software stocks broadly, the entire complex kind of has fallen back to where they were last April. To me, that's clearly an overreaction. So I think it makes sense that you'd start to see some of the groups that got hit hard mean revert, including the Mag 7.
So I think someone else made that point, that maybe the leaders in building out AI, maybe they stay where they are and stabilize, but maybe you get a rebound from some of the oversold things.
Yeah.
So you think we're getting to the point now where the initial weakness you saw in the markets, we're making a bottom at some point? What'd you say will be up for March?
Yeah, I think March is going to likely be an up month. I know it doesn't feel like that because of the way the end of February felt. But
comes in like a bear, goes out like a bull.
Yeah, it probably comes in with the better weather. But, the things like software, the Mag 7, and the crypto all had early weakness. They're all probably in the final stages or have already bottomed. And I think that helps lead us up to an up April.
Have you woken up in the middle of the night and looked at where Ethereum...
Listen, that's a big statement. I don't know about that. Bitcoin cycle doesn't have a bottom until fourth quarter, and that's 30K or lower. So, I think to predict bottom on Bitcoin, Ethereum, tough. You can try to do it. But, and in the Bitcoin cycle, it had some bounces, but at the end of the day, supposedly it's supposed to go a lot lower from here. So all these people trying to bottom call Bitcoin, Ethereum, and I noticed everybody trying to call the bottom there. It's all people that are very invested into it, as in pretty much all in. So just something to keep in mind there.
Hasn't said I can't go back to sleep.
No.
You're not worried yet?
No, because, Ethereum, there's the fundamentals, what's happening. So much is being built on Ethereum now. I mean, almost every major announcement of a tokenized fund is being built on Ethereum. Does
that translate to supply and demand dynamics that make the price go up, though? Or can you just keep building out all these networks at 1900?
I mean, that would be like someone saying all this activity is happening in the United States, but the economy shouldn't boom, Yeah. So if it's all taking place on Ethereum, then price follows. But we are in a crypto winter, so price doesn't matter.
No, Tom Lee, in all due respect, no. That's not how it works. That's not even how stocks work. Just because a business is making money doesn't mean the stock goes up. PayPal. We talked about PayPal just a minute ago, did we not? PayPal stock's gone from $300 to $40, right? Did PayPal stop making money? Did they stop having activity? No. Matter of fact, they're making more money than ever. They have more activity than ever, more total payment volume than ever. And yet the stock went from $300 to $40 over the past few years. And yet everything's up here. So to just say like, well, activity's happening, so no, that's not the way it works. And especially for something like Ethereum, no one has any clue how to value something like that. So just say like, well, some people are trying to build some stuff on it. So like, it's got, in all due respect, sir, that's not how this financial game works. No, sure.
Looking at gold and silver and ways of, hard assets, but that isn't always going to be the case.
I'd read you buying more Ethereum on the dip. How much more, and does that continue today?
Yes. So Bitmine's been buying about $50,000 or about $100 million of Ethereum every week, but the cash balance has grown to over $800 million. So it's able to, at the right moment, make a major buy of Ethereum. So I think we're getting ready for the crypto bottom. We're still buying about $100 million a week.
All right.
Yeah. No, and they'll be, if and when Ethereum ever bottoms and goes through another upcycle, like they'll be very well positioned for that, right? But you got to call bottom, I guess, tough thing to do. Volatility is here.
The volatility is here. Understand that. I don't think we have enough clarity. I don't think we have enough confidence in the clarity to expect on a day like yesterday, where it looked as though you had the all clear and the market's going to break out to the upside, to believe that can unfold. I think the same thing is true this morning. I don't think you have enough clarity to believe that there's a significant deterioration that's unfolding. So what do you do in that type of environment? You try to find opportunities where you can create alpha. I said yesterday, CF Industries, that is a name. That's a equity that I purchased yesterday. That's where I believe you can create some alpha because of this situation. You maintain exposure to the refiners, diesel prices. They are soaring today. If you believe there is a supply disruption as it relates to oil in the Middle East, look up north. Canada. You have Suncor, you have Canadian Natural Resources. Have some exposure to the financial exchanges. We have CME, we have ICE and Joe T. CBOE is the name that I am looking at currently. I think that is where you have to think about the alpha opportunity. And lastly, the Mag 7. I told you last week I didn't think you would buy Microsoft. I will change that right now. We own it in Joe T. I think there's resiliency in the Mag 7. I'm seeing it reflected in Microsoft and Apple and Meta.
Notice that also, that Microsoft move.
The best thing, I think, for a lot of the SaaS stocks and the SaaS apocalypse situation, and for a lot of these big techs, is actually this whole Middle East conflict here. And the reason being is everybody's now paying attention to that. And everybody seemed to just kind of be stuck in this mindset for weeks, or if not the last few months, around CapEx, and are they going to get the return on that, and all these question marks about that, and is SaaS going to be completely destroyed because of Anthropic and, all these different LLMs and whatnot. And so the fact that you gotten the conversation away from all that negativity and that negative loop that was just stuck around the market, and it got onto something else, I think that's actually the best thing that could happen to many of those stocks, because now all of a sudden it's like, okay, we're focused on this other thing over here rather than that.
To the green. Malcolm, over to you. According to Barclays today, as we see, many different parts of this market moving, the geopolitical risk index surging to its second highest level on record, only behind the events of 9/11. BTIG's Jonathan Krinsky with a note today that says, when missiles fly, it's time to buy. Typically, sharp moves on geopolitics are not durable, he suggests. What are your own views?
To that end, I think this is the kind of market where opportunities are created. It's not a time to be buying the entire market across the board. We haven't seen this level of dispersion within the S&P 500 in quite some time. I myself, along with other folks, have been sitting at this desk for over a year saying that a buyer's market is coming. This is the buyer's market. So Barclays had another piece out earlier today pointing out the fact that about 2.5% is the trading range on the S&P so far this year, but the average company in the index has moved 7 times that amount. So if you look at a company like a Microsoft, you mentioned a Palantir, for example, they're down about 15% so far year to date, but you've got like Devon Energy, for example, or Diamondback that are up more than that amount the other direction. And so the dispersion between materials and energy, which are leading the S&P so far this year, compared to financials and tech, which led last year, couldn't be better. And so I think this is an opportunity to be buying your favorite stocks and not necessarily trying to just grab everything as a basket.
So, Rob, many of the strategists out there today aren't.
And this is why I absolutely hate energy stocks. Energy stocks, people playing from this trader perspective of like, well, we're going to jump in them because right now oil's going up a lot and Middle East conflict, geopolitics going crazy, blah, 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 right? So it's like the hot play right now and people try to pile into it, right? And then it's a big game of like, when's the perfect time to get out? Is it next week? Is it next month? Is it, tomorrow? Is it today? Is it a year from now? And it's like, I just hate that. Like, I just love, as a long-term investor, to buy great companies that I can feel comfortable holding for years to go in the future. And like, we'll worry about selling that down the road, but I don't want to have to worry about buying this and trying to get out at the perfect price before it drops. Because that's the way it feels when you buy these energy-related stocks, right? Or commodities. It feels like you're buying and you're trying to time it out perfectly to sell it before it drops. Rather than when I usually go to sell a long-term investment, most of the time, I'm looking at it from a perspective of not like, oh, it's about to drop, so I need to sell it. It's just like, is this at fair valuation? I have a better place to put the money. Simple as that. When you buy these other things like energy stocks and ExxonMobil and Chevron and all these different commodities as well, you're looking at it from a perspective of, I got to get out before it drops. I don't like that, man. I don't like that. That does not feel good. No way, Jose.
Up their positive views of the market. Katie Huberty over at Morgan Stanley suggests that recent geopolitical events unlikely to change their bullish view on equities over the next 6 to 12 months. UBS saying as well, we expect only minimal or a brief disruption to global energy supplies. Obviously our eyes are on the Strait of Hormuz. What is happening there? They say, quote, we therefore stick to our base case that U.S. equities will produce good gains this year. Do you agree?
I think at the end of the year, we should see that. But, when you look at midterm election years, the inter-year drawdowns are close to 20%. And normally you can say, well, what's going to cause that? Here we've got an example of things happening exogenously. So I do think the market is still poised for an upward trajectory. But while we go through, to Malcolm's point, I think you're going to find good stocks along the way. We're adding to Disney at these levels at 15 times earnings. I think high-quality companies that are going to be on for sale, that's where you really need to focus on.
Yeah. I mean, Disney, not my favorite stock, but I can just understand some people buying it. Let's go ahead and take a peek at Disney before we wrap this up. So my issue with Disney is kind of around balance sheet a little bit, right? But it's a good company overall. Their numbers are messy. Messy numbers here. We'll have to look into that. Let me see the charts on Disney. Yeah. I mean, it's a good, stable business model, but nah, not interested. But what you should be interested in, if you want, it's the pinned comment down there. That is my free checklist, so you can see what level of investor you are. That'll be the first pinned comment, second pinned comment down there. If you're looking to apply, join a private stock group, private wealth group, get access to 1000xstocks.com. All that good stuff, that'll be the second pinned comment down there. Why these stocks are great deals right now. Now, before I give you these 5 stocks, I just want to share this with you guys. I do think this is very interesting to many people that will watch this video in March of 2026. And the reason being is understand you're in a month that is usually extremely volatile. This looks at the past 4 years and how much the S&P 500 moved each year during the month of March. 3.58% in 2022, 3.5% in 2023, 3% plus in 2024, and then last year almost a 6% move. So understand it's usually a very volatile month. It's going to be crazy. Focus on the long term, lock in, baby, and let's make some dang money, okay? I appreciate y'all for joining me here today. I've been prepping this video all day for you. I hope you appreciate it. The only thing I can ask from you, if you could just hit that little thumbs up icon on this video, smash that little like button. That's all I need from you. For everybody that's already done it, and you didn't even need me to ask, thank you for that. It means the world. Additionally, make sure you're subscribed here. Go down, look. Are you subscribed to the channel? If you're not subscribed here, make sure you're subscribed. Higher probability you'll get to see my videos in the future if you're subscribed here to the channel, okay? Alrighty, ladies and gentlemen, let's get rolling here. We got a lot to get into, so I just want to jump straight into it. Number 1 of these 5 stocks here today, ladies and gentlemen, it is CRM is a ticker symbol. Salesforce is a position I am building rapidly right now. And I mean rapidly. I'm buying every share in sight. I've got this position size up to almost $200,000 alone in the public account. I've been buying in my other private portfolios as well. I'm loading shares as we speak. Okay. So when it comes to Salesforce, I always want to try to break these business models down as simple as I possibly can. Okay. And I think AI does a great job of breaking business models down, because you hear something like Salesforce, you're like, okay, they're like a software, they're like related to big companies. What is this, right? All right. So I said, break it down like I'm 10 years old. Okay. Imagine you have a lemonade stand, but it's super popular. It's a global lemonade stand, and you need to keep track of thousands of customers, how much sugar you have left, who bought the most lemonade today, all those sorts of things, right? Salesforce is a magical digital notebook in the sky, the cloud, that helps businesses do exactly that. The rent a tool model subscription. Instead of buying a giant expensive computer program that you have to install, like a video game console, companies rent Salesforce over the internet. Like Netflix, you pay each month or how much you use it, in some cases with Salesforce. Why it's smart, as the business grows, then you pay for seats, more users. If the company shrinks, you pay for fewer, right? It's flexible. The one-stop shop for customer info. Salesforce is a CRM, customer relationship management tool. Think of it as a superpowered digital Rolodex. It tracks who your customers are, what they bought, and when you last talked to them. It helps your sales teams sell more, service teams help faster, and marketing teams find new customers. Now, this is all very important if you ever run a business. If you run a business, naturally over time, you're going to have lots of customers. To be able to track the data on what these customers are buying, how much they're spending with you, what products might be good to sell them next, all these sorts of things, right? Very, very important thing. I mean, like very, very important. Like these are key things to running a successful business. The cloud factor, you don't need to install anything. As long as you have internet, you can use it on a computer, phone, or tablet. It means all your data is safe in one place and not a one single, breachable computer. Now, Salesforce, keep in mind, they're going through it with all SaaS stocks right now. A lot of question marks about these business models in regards to AI, disruption, those sorts of things. This is not their first rodeo. This has happened several times over Salesforce's history, including when we started to move to the mobile revolution. People were wondering, like companies like a Salesforce, like how they would be able to transition to, people wanting to use these products on, the mobile landscape. Is it going to be disrupted? Like they've had to face a lot of questions over the years. The App Store for Business. Just like your phone has an app store for games and tools, Salesforce has App Exchange. Businesses can buy extra tools to add to their Salesforce system, such as tools for accounting, specialized selling, or team chatting, such as Slack. Many of you guys probably use Slack. The Helper AI Agent Force. Salesforce now uses AI helpers called Agent Force that work alongside people. These AI bots can automatically answer customer emails, help sales teams, and handle boring repetitive tasks, making the software worth more money to companies than if you didn't have it, right? In short, Salesforce sells a rent-a-brain service that helps companies organize, understand, and talk to their customers to make more money. And that's the ultimate, right? The bottom line is, whatever you're paying for Salesforce, it's Salesforce's job to make sure you make more money off them than whatever you pay. If you're a big business and you pay Salesforce $3 million a year, it's very important Salesforce makes you way more money than $3 million a year, right? Now, in regards to their latest quarter, current remaining performance obligation, $35.1 billion. That was up 16% year over year, so that way outstripped revenue. That's something we actually want to see. And 13% on a constant currency basis. Remaining performance obligations came in at $72.4 billion. That's up 14% year over year. That's what we want to see. We want to see these numbers outgrowing revenue. If revenue is up higher, then essentially remaining performance obligations, that's actually not what you want to see, because that means you could have revenue shortfalls in the future. Your performance obligations are up 14% year over year. That's likely going to mean great things for revenue down the road. Fourth quarter subscription and support revenue came in at $10.7 billion. That was up 13% year over year and 11% on a constant currency basis. All the numbers for Salesforce, very, very impressive. They returned $14.3 billion to shareholders, including $12.7 billion in share repurchases and $1.6 billion in dividends. They announced a $50 billion share buyback, which was a shocker. They also just increased their dividends. So if you own Salesforce stock, you're going to get paid even more money for every share you own every 3 months, essentially. They upped it to 44 cents per share. Now, the part of the business everybody has an eye on is right here. This is very important, what I'm about to show you. Very important. This is Agentforce. Annual recurring revenue, it's up to $800 million now. That's up 169% year over year. This is a component of the business. Everybody wants to see how are they adapting to AI? Do they have products and services that their customers want? And clearly, based upon the numbers, it looks like they do. Agentforce and Data 360, annual recurring revenue, including the Informatica acquisition, was up 200% year over year. Huge number, huge number. So the moral of the story is AI is going to likely end up helping. Just based upon the numbers, it's going to end up helping Salesforce massively. Everybody's looking at all these companies. They don't want any piece of them right now, right? Their stock prices are all down huge because they're scared. They're scared that AI is going to disrupt them. They're scared that their companies aren't going to be able to make money from AI. It looks to me like many of these companies, not all of them, but there's definitely going to be a good chunk of them, like a Salesforce, is going to make, and in the end, they're going to make a fortune from AI. What the specific margins are and all those sorts of things, we'll figure all that out as time goes. But the moral of the story is Benioff running this company, he's going to make a fortune off all this in the end, okay? Now, here, I'm going to show you my bull case, base case, and bear case for where I expect Salesforce stock to go over the next few years. My bull case, keep in mind, whenever I run a bull case on a company, only about a 10%-ish probability that happens. Base case, I would say about 70%, somewhere around there. 10% of a bear case, and then there's like a 10% probability that something crazy happens, way better or way worse for the company than I anticipate, right? But this is my bull case for Salesforce. 14% revenue growth per year, 2026 to 2029. 22% net income growth, 27, 28, 29. Keep in mind that, they got the acquisition all done in Informatica, so their bottom line should be a lot cleaner now at this point in time. Net income margins, I have them going to just over 40% come 2029. 29 to 34p, I think is very fair for a company like Salesforce growing at these sorts of growth rates. And we're talking about, this would give me a CAGR in this situation of around 50%, ladies and gentlemen. 50%! 50% CAGR. Oh my gosh, okay? I hope that happens, but that's not my highest probability. This one is. This is my 70%. I think they're going to likely, high probability, they're going to do somewhere around these numbers, okay? My base case for Salesforce, 12% revenue growth on average per year, 2026 to 2029. That's not crazy. It's a very doable number for Salesforce. Net income is going to explode obviously this year because they get their one-offs out of the way and acquisition all done, all those sorts of things. So basically I have them in 2026 doing net income right around $16.5 billion. Not a crazy number. That should be somewhere around there. Then after that, 20% per year net income growth, which should be very doable with 12% revenue growth. That puts them at net income margins of 42% come 2029. 27 to 32p is very fair for a company growing top line low double digits and like a 20-ish% net income growth, right? So 27 to 32 PE. We're talking, I get a 44% compounded annual growth rate on the low end and 50% on the high end. This stock should be, under my base case assumption here, somewhere between $800 and $1,000 come 2029. You can buy this stock today for less than $200. You can see why I'm adding Salesforce so aggressively. I think there's significant upside for the stock. I don't know if I've ever had a bear case with this much upside. Like literally, I don't think I've ever ran numbers on a bear case and had this much potential upside, ladies and gentlemen. Okay, here we go. My bear case for Salesforce, 6% revenue growth on average, 10% net income growth on average, other than obviously the jump up here in 26 where they do about $16.5 billion, right? Net income margins go to 40%. 22 to 27p is pretty fair for a company with these sorts of growth rates. And I still get a CAGR that's in the 20s and 30s. Come on, man. Salesforce, CRM, there's a reason I'm buying this stock hand over fist right now. I could be wrong about it. I'm never 100% right all the time, right? I'm going to pick some stocks that are bad ones. Maybe Salesforce is, but dang it, I'm willing to take that risk, baby. I'm willing to take that risk. Let's go, Benioff. Number 2 of these 5 stocks up here is, guess what? Number 2, and it's my favorite $2 chuck in the stock market. A matter of fact, it's my favorite stock in the entire stock market that's priced under $5 a share. Everybody can afford this one. Honest Company. HNST is the ticker symbol on this company. They sell a lot of needs-based products. Think of things like wipes, diapers, lotions, soaps, shampoos, a lot of baby care related products, okay? So, and by the way, the stock has done nothing over the last year. It's been a very volatile stock, but hasn't done anything, a lot of big change in the business model and whatnot, okay? Carla, the CEO of this company, let me be very crystal clear about this, okay? When she got hired as a CEO of this company, she came over she was like a vice president of Amazon prior to this, and held some other important roles with companies. But let me be very crystal clear. This company was on their way to bankruptcy. It was a $1 stock. They were done. Their balance sheet, they had hardly any cash on it. Their income statement was a complete disaster. Their margins were a complete disaster. This company was facing bankruptcy a few years ago when she joined, okay? And now this company, keep in mind the market cap of this company is only $200-something million, okay? The company now has cash and cash equivalents of near $90 million and no debt on the balance sheet. It's unbelievable. The free cash flow last year went to $13.6 million. The previous year was at $1.1 million. And prior to that, their free cash flow was a disaster. There was no free cash flow. It was like awful, okay? They've gotten in such a strong financial position now with this company that they just announced a share buyback, ladies and gentlemen, of $25 million. This is very impactful for a company like this. There's a company with only, like I said, the market cap as of today should be somewhere in the $200 million range, maybe $300 million. It's very low market cap. So when they say they're going to buy back for $25 million, keep in mind, this company could likely generate significant free cash flow again this year, in the next year, in the next year. So this probably isn't their only buyback. You're probably looking at a lot more big buybacks coming. This is probably just a little appetizer here, because what else are they going to do with all this money? Like, they can come out with new products under the Honest brand. They don't really need to acquire other companies. They have a brand that they can just keep building under that brand. So likely the thing with Honest is more big share buybacks are likely coming. They'll probably exhaust this in no time, and then they'll probably come in with another big dog, another 25 mil, right? Why not? This is as far as their outlook. Now, keep in mind, their revenue is going to be down significantly in 2026, and that's because they're getting out of a lot of bad businesses. There's a lot of bad businesses Honest used to be when it was a messy business model, when Carla inherited this company, essentially, and she's getting out of those bad businesses that basically were horrible from margins. They took up management's time and attention when they were just garbage businesses. She's getting out of all those now that they're at a stable place financially, and so it hurts revenue this year, but at the end of the day, if you're a long-term investor, you're focused on the company for the next 3, 5, 7 years. We want a company that's sustainable and focused on high margin businesses that we can be, big profits. And then you can pour money behind those businesses, right? And advertise, get more customers into your network and continue to build the business, right? So organic revenue, they're expecting 4 to 6% growth. Carla seems like she's been pretty, I would call sandbag type numbers so far. So if she says 4 to 6% organic growth, don't be surprised if it comes in ahead of that for the year. Volume led by quarter-over-quarter improvement throughout 2026. Adjusted gross margins expecting low 40s. We'll come back to that later. That's an insane number. This company used to be gross margins like in the 20s. Insane. They're talking about adjusted EBITDA, earnings before interest, taxes, depreciation, amortization, $20 to $23 million. For a little market cap like this is significant, okay? No, you might not think of Honest as a growth company because they're getting out of these bad businesses, so their revenue is going to technically be down this year, but this is a growth company. Look at this. Leading baby care in wipes. They kind of have like 3 pillars of what they're trying to do here, okay? Growth priority number 1, winning in baby. 25% 2025 consumption growth in, baby wipes. That's incredible for this company. That's a significant growth driver. No, they also, in regards to, baby personal care growth, this is things like soaps, lotions, all that sort of stuff. 12% consumption growth. That's what you want to see. That's not just them filling the channel, right? Consumption growth is people actually buying it off the shelves. That's phenomenal. Double digits there. Additionally, they're talking about accelerating beyond baby. So entering the kid personal care items. So first launch in big kids aisle with a 6-item lineup, which guess who they're partnering with this? Ladies and gentlemen, Disney's Pixar. This is big. Like this is a little company, and they're doing a partnership with Pixar, Disney's Pixar. I don't know how she landed that deal. I don't know what she did. Bravo. That's all I'm gonna say about that. That's big, okay? Support flushable wipes distribution. Look at this. 175% growth, consumption growth last year in flushable wipes. This is a business taking off. I mentioned this and some people laughed at it recently. Like, guys, This is like big business, right? People are like, oh, people should just use bidets. Dude, not everybody has bidets. Like, especially in America, I'm like, hardly anybody has that. Are you kidding me? So, you either have two options. You want to wipe, right? In America, you have toilet paper or you have flushable wipes, and flushable wipes are a lot better. That's all I'm gonna say about that, okay? The whole bidets and all that stuff, like, I'm just telling you guys, like, hardly anybody has those in America, okay? And sanitization wipes. Look at this, 73% consumption growth in 2025 for sanitizing wipes. Significant. And keep in mind, these businesses, as some of these might be smaller line items for revenue right now, because the diaper business is so significant. But think about it. They grow 175% last year. Then let's say they grow this business another 100% this year, right? All of a sudden, those numbers start to become very big and very impactful and very margin accretive, right? Look at this. This is adjusted gross margins. This is where they were shortly after Carla took over the company. Look at 29%. Then they bumped up 38, bumped up a little bit more last year. Now they're talking about adjusted gross margins approaching low 40s. Incredible. Absolutely incredible. Ladies and gentlemen, Honest is getting out of the gulag this year. I believe Honest is getting out of the gulag in 2026. The gulag is under $5. I believe it's getting out and it's never coming back. And the reason I really believe this is if I look at the balance sheet, they got it now. They're not going to have any tough decisions to make in future years. They made the tough decision to get out of these other business lines, and so their revenue goes down short term. People are already looking past that, and that's why the stock's already spiking after earnings, okay? The share buyback comes in now, so now you're going to have a huge buyer of a very small market cap, and they did a $25 million. Like, who's to say they don't come in? Who's to say they don't exhaust this over the next 6 months and then say, you know what, we're board of directors just authorized another $25 million buyback. Why not? They got the balance sheet for it, no debt, and you're loaded with cash to the sky. Why not, right? Unless you were thinking about selling the stock. So the bottom line is here, ladies and gentlemen, is I think this stock is getting out of the gulag and never coming back after this year, okay? Alrighty, before we get into number 3 of 5, look at those 001s, by the way. Before we get into number 3 of 5, 2 pieces of housekeeping here. The first pinned comment down there, ladies and gentlemen, today will be if you're looking to apply to join our private stock group, get access to all my best course curriculums, become a master stock market, millionaire playbook, stock options mastery, dividend investing mastery, the valuation masteries, learn how to value companies, access to my private Discord chat, exclusive weekly videos, all that good stuff. That will be the first pinned comment down there. That's really if you have $100,000 plus net worth. If you have less than $100,000, you can always apply. Probably not a good fit for you, but that is pinned comment number 1. The second pinned comment I'm going to have down there today is for a free resource. I just put this together this past week for you, okay? This resource is a checklist. So if you want to know where you're actually at in your investing journey, because a lot of people think like they're like much further along than they are, made you a whole checklist. And based upon how many of these you get green on versus how many you don't, right? You're going to know where you actually stand as an investor. Are you like good? Or are you like you're getting there? Or do you have a lot of work to do? So it's a completely free resource. I can send over that PDF via email or via text. Once again, that's free. So if you want to check that out, that will be the second pinned comment. Okay. Number 3 of these 5 stocks is Now. ServiceNow. This is a $109 stock here today. I came in with a big boy buy on February 11th. I bought 1,000 shares of ServiceNow in the public count at $101.38. So far, I'm up $8,000 on this position overall. ServiceNow. I graded the income statement. I put this in the income statements tab inside my private stock group's Discord chat. B+ grade overall. As far as total revenues, $3.56 million versus $2.95 million in the same quarter last year. They kept all the expenses pretty in check, honestly. And so income from operations went to $443 million from $374. G&A was actually the one trouble spot, I'll say, in regards to this, okay? Income before income taxes, $541 million from $463. Net income, $401 million versus $384, but a lot of that got killed because of income taxes. That's why I gave him a B+ grade overall. Diluted EPS, 37 cents versus 37 cents. You know, if it wasn't for that huge income tax hit there, this would have been an A grade income statement overall for ServiceNow. Now, ServiceNow, you're like, what does this company actually do? Like, are they like a Salesforce? Like, okay, here's the deal. And keep in mind, ServiceNow and Salesforce do compete in some ways, okay, but not through everything. And they both have, Salesforce is much bigger when it comes to sales and making money, ServiceNow is much more important when it comes to IT tickets and like a lot of the communication within a company, essentially. Okay, ServiceNow is like a super organized digital assistant for big companies. It acts as one main cloud-based platform that replaces messy, paper-based, or emailing back and forth work with fast, automatic digital workflows, helping employees manage IT issues, HR requests, and customer support in one place. The problem: imagine a company where if your computer breaks, you send an email. If you need a new chair, you fill out a paper form. If you have a question about pay, you call someone. It's chaotic. The ServiceNow solution. ServiceNow brings all these requests into one box, the platform, workflow automation. When you submit a request, it automatically goes to the right person, tells them what to do, and it tracks it until it's fixed. The business model: companies pay a subscription fee like Netflix to use a platform, plus extra fees for seats, how many employees use it, and special extra tools. IT workflows, fixing broken computers or software; employee workflows, helping HR onboard new people; customer workflows, handling customer complaints. In short, it helps companies fix problems faster and work smarter. If you ever worked in a big company, you know this is very important. Like, just if you've ever worked in a big company, you know this is important. Like, or it can be a disaster. Like, bottom line, if you got a small business, you got 3 people that work for the business, okay, it's not that big of a deal. You got 30,000 people that work for the business, it's a big deal. You got 3,000 people that work for the business, it's a big flipping flapjack and deal, ladies and gentlemen, okay? Here are my projections for where ServiceNow stock goes over the next few years. Under my bull case assumption, I had them doing 20% revenue growth on average, and then 27, 29, 25% net income growth. This coming year is going to be kind of like a big jump up in regards to net income getting back on the right track. So you got 20% top line, 25% bottom line. SaaS related company like this, 40 to 60p be fair. We're talking 29 to 42% CAGR here. But that's my bull case. That's not what I expect. Here's my base case. This is what I actually expect for ServiceNow. 17% revenue growth on average. Okay. 30 to 35 PE here. I have them doing in 2029 about $25 billion of revenue. I have them doing about $7.3 billion of net income. 30 to 35 PE would be very fair for a company growing at these sorts of growth rates. And I get a CAGR right around 20% for the stock. It's a very solid overall number for this company. Okay. Now, in regards to ServiceNow, look at that revenue chart, and this is where they're expected to go. Is that perfect or is it perfect? I mean, it's just gorgeous. We're looking at 1000xstocks.com right now, charts feature, by the way. This is where their trailing 12-month earnings per share is at. And look at what is expected to happen to this beast over the coming quarters. It's taking analysts' estimates into average. Incredible. Free cash flow, this is where we're at on a trailing 12-month basis. That continues to build for ServiceNow. Free cash flow per share continues to build. This is where we're at right now on a trailing 12-month basis. Meanwhile, look at this. A very important thing we have on 1000xstocks.com under the charts feature. This historical PE ratio, okay? Look what has happened to their PE ratio, ladies and gentlemen. So you're getting this company with all-time high free cash flow per share. But for the cheapest PE ratio you've seen anytime recently, or probably ever since this company basically went public. I mean, it's insanely cheap. That matters. Look at the operating cash flow. Oh my gosh. Operating cash flow has exploded for this company. Is where we're at right now on a trailing 12-month basis. Operating income continues to pile up for the company. This is where we're at on a trailing 12-month basis for operating income. Shareholder equity continues to pile for the company. Meanwhile, shares outstanding, they've been able to keep that pretty flat, which is always kind of a scary thing for these sorts of companies because they can do a lot of stock options, right? Share-based compensation, and they've just been able to keep that in check, probably from some buybacks that offset that, in my opinion. Are you not entertained? I hope you are entertained because these are bangers on bangers, okay? Number 4 of these 5 stocks is Celsius Holdings, energy drink company. This is a position I have in the public count, right around a $200,000 position. I have 4,000 shares, average cost $24.39. I know it's a lot more expensive nowadays at $49, but guess what? It's still a steal deal. I'm up $99,000 on this position. I have 0% interest in selling any of these 4,000 shares anytime soon. Okay, so Celsius. This used to just be a standalone company that just used to own Celsius, that brand, and that was it, right? And this has been a huge growing brand. Like 5 years ago, no one really heard of Celsius, and now I feel like it's a very famous brand. If you pay any attention at all to really energy drinks, you probably are aware of Celsius, okay? Also gym culture, all those sorts of things. Okay. Now they also now own this brand called Alani, and they also own an old historic brand in the energy drink space, which is called Rockstar. And these two brands they've acquired in the past, few months essentially. Okay. Alani, they finally closed that deal. I think it was 9 months ago or so. And Rockstar was a little more recent, and now they have distribution everywhere with Pepsi, essentially. Okay, well, everywhere you really want to be. So my wife's actually sent me this photo of this display here, but you can see how they're starting to use their displays to promote Celsius, Alani, and Rockstar all in one place. And they have a deal here: buy 2 get 1 free on Alani. So, and then Celsius $2.29. I love how they're going to use these displays to, make all 3 of the brands prominent, because remember, this company wants to become a drink giant. They're on their way to becoming that. Latest quarter for the company, I graded them a B-. Income statement, posted this inside the private stock group's Discord chat. As far as revenue, went to $721 million from $332 million in the same quarter last year. Gross profit went to $341 million from $166 million. They had this one-off distribution termination fee here of $80 million. Income from operations, $26 million versus $18 million loss in the same quarter last year. As far as net income attributable to common shareholders, we're talking $9 million versus $25 million loss. Diluted EPS for the company continues to build. They're now at about 20% market share as of last year in the energy drink category, which means they're ready to take on Red Bull and Monster head on. This is no small little niche company anymore. No. They're an energy drink giant. They're on their way to become an overall drink giant. Okay, $5.2 billion in annual U.S. retail sales. Now, here's the deal. Okay, Rockstar, if they can revive that brand a bit, right, and get growth back, and I wouldn't be surprised. They know how to do this. They know how to do this very well in terms of getting growth back. If they can do this, they can probably get Rockstar to take out C4 and take out Ghost in regards to their market shares there, and maybe grow this into the 5th biggest brand in energy drink. And then they would have the number 3, number 4, and number 5 most popular energy drink brands at that point in time. They might be able to pull it off over the next year or two. Alani should go from about 6.4% share to, I think, probably 10% share, maybe even a little above 10% share. Celsius, meanwhile, is at about 11%. I think they could push to 14 or 15%. And you wonder who's going to lose market share, because to gain market share, somebody's got to lose it. My opinion is it's going to be Monster. It's going to be Red Bull. I do think those companies, Red Bull, they lost their big dog several years ago. He passed away. Monster, those guys are up there in age now, and they look like they're kind of slowly, taking a back seat. And so Celsius really looks like the company to outperform these other kind of historic brands like Red Bull and Monster. Those companies obviously dominated the 2000s and into the 2010s, but I really look at the 2020s and 2030s as, Celsius's time to shine. And so that's what I see kind of playing out here. No, Celsius is on their way to becoming a drink giant, and about a $12 billion market cap right now on this company. Look at somebody like a Monster, $79 billion. This is where Celsius is aiming for long term, right? To become a monster type company, an absolute monster. So my opinion is Celsius likely takes out the 80s this year. That's where the stock used to be back in 2024, early 2024. I think they're coming for those 80s, and then we can talk about building a new base from here, essentially, right? And so, yeah, I really like Celsius. Great company. Hey, and also, sometimes you need a company you just sleep well at night. You don't have to worry about AI disruption. There you go, Celsius. Is AI going to disrupt energy drinks? I don't know. I don't know if the LLM is going to automatically juice me, right? Okay, number 5 of these 5 stocks is, I love this one. It's an old friend of the channel. It's been a long time friend. You know who it is? Elf on a shelf, Elf Beauty. $81 stock here today. It's a long-time friend of the channel. Since I made the initial investment in the public count, I'm up 1,021% on this stock. It's been a 10x. It's incredible. Now, not a 1,000x like 1000xstocks.com, but a 10x is pretty good, right? Now, there's Elf owns a few different brands, but the 3 brands you really got to know if you want to own the stock or look into the company. Elf is the main brand. That's cosmetics and skincare. Another brand that they bought a few years ago, Naturium, very popular and been growing very rapidly in the skincare space as well. And the third brand you really got to know is this one. This one's called Rhode. It's a company that basically Hailey Bieber started and sold to Elf, and she's just done a masterful job of marketing this company and really giving her customer base the sort of products they really want. I mean, she's just brilliant. There's no other way to put it. Like absolutely brilliant, the job she's done here. Here's the deal, okay? Elf's earnings per share over the next year are going to climb substantially. If we look at free cash flow, it's already started to build. This is nothing yet. Just watch how the free cash flow builds over the next few years, okay? Elf is in a position now where they can continue to grow their revenues at a sustainable pace, right? But I think the real story for Elf over the next 2 years, because I don't believe, my personal opinion is, I don't believe Elf is going to buy out any other companies in 2026 or 2027. I think they're going to keep those years to just focus on increasing margins, increasing profits, and increasing cash flows. 2028, 2029, maybe they get out there and they try to buy another company or something like that. But I don't see that being the situation here over the next, we can call it 12 to 24 months. I think they're just going to focus on margins, growing revenues, growing profits, growing cash flows, and you'll see all these line items just explode over the next few years. And now we got the tariff drama really out of the way. We already know worst case scenario, so they've already been able to offset that. That's great news for the company as well. Okay, this used to be a stock that was $200. I think it's back on its way to $200 over the next 24 months. It's going to be a volatile ride. It's going to be up. It's going to be down. It's going to be moments you're like, oh my gosh, this stock's going to buy me a new Lamborghini. There's going to be times you're like, oh my gosh, is Elf ever going to go up? It's a roller coaster. It's always been that type of stock. It's always been a roller coaster ride. The moves are dramatic, but the moral of the story is I believe the stock's going back to 200 plus over the next 24 months, which means at $81, there's significant upside. I really hope you enjoyed today's video. I hope you appreciate it. I appreciate you joining me for this one here today. The first pinned comment down there is if you're looking to apply to join private stock group, private wealth group, access to 1000xstocks.com, private Discord chat, all that good stuff, all in one place, exclusive weekly videos. That's the first pinned comment. Second pinned comment down there is for a free resource in regards to a checklist that I put together over the past week that you can really, grade yourself and really figure out like how much do you still have to know? And those sorts of things. You find out, are you an investing god? Are you a legend in making? Or are you just a noob in that? Okay. All right, guys, appreciate you joining me. Much love and have a great day.